yourself on mute. Keep yourself on mute as it is a Zoom call, so people would be able to hear you. We're going to be posing a few questions in the chat box, so can you please keep your eyes out for those? There will be a survey, and the survey questions are going to be as follows. So we're going to ask you to rate in order of importance to you, the first most important, second most important, third most important out of these questions. Number one, what would you like us to focus on? So out loud, trigger leads, would you like us to change the 3% fee cap, either increase the cap or remove it entirely, or remove the Fannie Freddie limits on second homes, investor properties, and the adverse market fee, or fourth, expand homeownership opportunities for minorities, first responders, hospital workers, and teachers. So again, please look for the questions in the chat box and rank those things in order, first, second, third. We're also going to pose the question of whether or not you are interested in us looking at being able to deduct non-reimbursed employee expenses. So for those of us who are on W-2s and still have some pretty robust expenses that we pay every month for our business, would you like to be able to deduct them again? So with that being said, we've had a very big week in the mortgage industry. I don't know if were you guys all paying attention? Was there a Supreme Court ruling that we had been waiting for? Yes, there was. So the Supreme Court ruled that the FHFA director could be removed at will. And when that happened, Mark Calabria resigned. Mark Calabria was on our agenda this afternoon and has politely declined to be here. So we will be filling in the blanks with some other things. So we will have Julie Shaffer, who is the Acting Associate Deputy Assistant Secretary of FHA, joining us. We have some attorneys who are going to talk about the CFPB's new focus on discrimination and what they think that brokers should be looking at. And we have a very, very, very robust conversation about the VA aspect of our business. So we should wrap it up around 3 p.m. Eastern time. And with that, I'm going to throw it back to Roy.
And I'm throwing the ball to Rick right now so he can start off our, Rick, you got to give your background and then introduce your guest from the VA.
Yeah. Thank you very much, Roy, and thank you, Audrey, and thank you, President Kimber White, for the opportunity. Hi, everybody. My name is Rick Betancourt, past president of the National Association of Mortgage Brokers from October of 18 to October of 19. Much of my business in my 19 years in the industry has revolved around assisting our military community, our service members. I work with all aspects, whether it's a PCS or a Gold Star, active duty or veterans. So the VA has been a big part of my business, and that and my involvement in NAMB opened the door for me to create some long-lasting relationships and friendships with some of our VA friends down at VA Central Office and the various regional loan centers. So it is truly an honor for me today to have the opportunity and the ability to have two very special guests on our legislative call today. We are very, very lucky to have Terry Rauch. Now, Terry, his resume is beyond, I heard it the other day, beyond my ability to articulate it, but he is currently at VA the Assistant Director of Loan Policy and Valuation. Now, he's going to be our first speaker. Then the next guest that we have with VA, and this is, we're so lucky to have these two gentlemen, James Heaslett, who is the Chief Appraiser for the Department of VA Loan Guarantee. So we are so lucky as members of NAMB and attendees at this conference to have these two gentlemen here to kind of elaborate on VA, what's going on in VA, as well as some valuation aspects of the VA. And then they'll be able to answer some questions that all of us will have. So with that being said, I am going to turn my mic off and I'm going to turn the mic over to Terry Rauch. And Terry, thank you very much for being a guest today. And the floor or the screen is yours.
Oh, thank you very much for that kind introduction, Rick. On behalf of our executive director, Jeff London, I wanted to say that we are very pleased for this opportunity to speak about our program and hopefully provide you with some, and your group, some valuable insight that you can take back to your shops. Now, as you said, about my background and experience, I'll go a little bit into that. And it's I don't think it's that impressive, but I've been in the mortgage industry since the early 90s. And I've literally covered everything from sales, operations, underwriting, secondary markets. I've worked in wholesale, worked in retail, and virtually, I think, in all variations in between, and at all levels of leadership. Some of the companies that I've worked for have included Transamerica, Long Beach Mortgage, Argent, Countrywide, City Mortgage, just to give a little flavor. So during the mortgage crisis, I think that's where Rick was mentioning. I worked for the FDIC, where I worked as an asset manager and ran the operations for all those banks that were closing throughout the country. My teams would go in and close up shop and then resell the assets. One of those that I did was a little different. And that one was similar to like the GSEs, in which the government turned it into a conservatorship. And so when that institution failed, which was called IndyMac Bank, they put me in as the receiver / chairman, president of the bank. And I ran the bank as an ongoing entity until we could get it sold to another investment group that was called Dune Capital. And they later turned the bank into what is, or had been known until it sold, as One West Bank. So if any of you know some of that history, then you'll know what that's all about. But anyway, but before coming to the VA, I did work at HUD. I worked there for several years and in different roles, including as a deputy director in single family housing, and also as the chairman of HUD's Federal Credit Union, and also was a member of NAFQ's regulatory committee. So I've got kind of a very varied background when it comes to mortgage and banking. So again, appreciate the opportunity to speak about our program. And so we'll dive into some of the aspects and the overview of our recent changes in our organization. So as many of you know, in the past, we had a regional office structure, and this is where loan guarantee officers were stationed at each of the 8 regional offices. And the folks in those offices then reported to their individual office directors, which were outside of the LGY system. And so this was clearly a cumbersome structure, which caused confusion in the industry. And, even in my short time here and being in the industry, I knew that there were a lot of complaints that people were getting, and a lot of it revolved around mixed information. So I'm happy to report the VA did listen, and they have changed that structure now into a single national structure. So this is where all of those loan guarantee employees out in the field, they report to central office in DC. From the feedback that we've been receiving so far from our industry partners, this has been very, very positive. And one of the big things that we were hoping to reduce or cut down was those inconsistencies among our field offices from the information that was going out. And I think we've really made a dent in that. And so if there are continued inconsistencies, I'd like to hear about that. But again, that is something that we felt that we've made a real impact on. And so anyway, I know there were many of you affected by that. So again, if there's more changes that are affecting you, would love to hear about it. So I'll turn now to the next page, which is something I think all of you are pretty familiar with, and that's record-breaking loan volume. So like many of you out there, we've also experienced a great deal of volume in the last couple of years. Before I go into those numbers, I'm just, I can't imagine that the last 15 months and what's transpired over the course of that time and what we've seen in the markets. I certainly wasn't predicting, what has been happening. We still clearly don't have a clear picture yet where that path's going to lead us. But with all that growth comes new challenges. But we'll save the challenges part for another day. I do want to get into some of our loan totals, give you an idea of what we're seeing and experiencing. And so for our fiscal year to date total loans, we've exceeded now over 1.1 million in loan units. This is roughly around 34.7% year over year increase. It's just phenomenal with what our staff has been able to accomplish with those numbers. We were never set up or equipped to cover that much volume, and we continue to handle the capacity. And I can share with you, we do have additional staff coming on in the new fiscal year to help with the increased volumes. Just to kind of break it down a little bit, our EARL volume. So out of that 1.1 million, we had 173,000 of those loans that were EARLs. And our average loan size on the EARLs was around 297. Out of that grouping, we had a little over 312,000 that were purchase loans. And a little uptick on the size of those loans. We had those loans were averaging around 334,000. So we're very pleased with those numbers. And just to give you an idea of where we are in compared to last year, we booked a little over 1.2 million units last year for all of fiscal year 2020, and we're right there halfway through. So we're anticipating another record-breaking year, and again, it's attributed to a lot of what you do out in the field, and we really greatly appreciate the efforts that the industry is making for us. So now I'll move into some of the topics you were looking for in expanded eligibility for Reserve and National Guard members. This is Public Law 116-315, Veterans Healthcare and Benefits Improvement Act of 2020. So I know we get a lot of calls on this, trying to clarify what this means and how it affects your business. Essentially what the act did is it defined or expanded the definition of what a veteran is for VA loan benefits. Now this really affected the certain individuals who performed full-time National Guard duty as defined by Title 10. So prior to the implementation of that law, service members and veterans of the Air National Guard and the regular National Guard were required to serve a minimum of 90 days, cumulative days of active duty, and were also to serve honorably for at least 6 years with points earned for their weekend drills and other training, or had been discharged or medically retired due to a service-connected disability. So those were the previous requirements. The passage of this new law has now given service members that are supporting certain national crisis operations an accelerated path to VA home loan benefits. So with this expanded eligibility, what does that mean? It means a lot of new service members have already taken advantage of it. So I'm happy to report that we've approved now in this fiscal year 708 COEs under the expanded eligibility. Those are actually approved COEs that go through. It's a bit of a manual process for us, so to help ensure the accuracy of our determinations, we needed to put in some additional procedures. So for example, a COE that comes in that is denied, we have a loan specialist before they can actually deny that. They need to take it to their manager who reviews it and then must sign on that denial. So a loan specialist cannot deny those on their own. So we just want to make sure that we're getting things right. It is a difficult law, and many laws when they first initiate like that do require some hand holding. So we'll continue to put out some language with that and try to have some policies in place that will continue to clarify some of those processes for you. Now, I'm going to briefly discuss some of our technology and IT systems and what we're doing to improve in there. Some of you already know loan guarantee has been stating in other meetings that we're going to invest roughly $50 million into our systems, which we've already started doing this, and we're going to continue doing these upgrades over the next several years. One of our goals is to get to guarantee certainty, which basically means we want to get to a point where you'll receive a guarantee at the time of closing. For us to get there, obviously, we need to get a lot of data, and we can't extort enough of it, right, to get to that point. So this is going to take us some time to build out the systems to absorb and to intake all of that data and then disseminate it. But I'm happy to tell you that we are definitely full speed ahead on this process. So keep staying in tune. We'll continue to make the upgrades, try to bring you in and have you do testing and so forth as we do those upgrades. Now, since this is a legislative conference, want to at least kind of give you a little bit about what's happening in that space. And maybe what we have going in the pipeline. But I think, as you've probably heard in the past, it's something that we really can't go into any great details, but there are a number of issues that we are busy with. And, when it comes to the mortgage activity in DC, I am sure probably a lot of you know more than and hear more than what I do. But there are a number of things happening, and I think some of those have been in the press for you to kind of follow along with. Again, just want to say appreciate this opportunity to talk with you. I think this is the first time that I've talked to you in this setting in my position. So I sincerely appreciate everything that the industry is doing in this group to deliver the VA home loan benefit to our veterans. And now I'll turn it over to Mr. James Heaslett, our Chief Appraiser, and he will probably be able to take some questions after his presentation. I'm giving him a little extra time to do so. So James, floor is all yours, sir.
You're on mute, buddy. James, you're on mute. Terry, James, yes. Look at the.
See, I'm just a knuckle dragging gunny. I need an assistant to help me get off mute because. Hey Terry, thanks for the introduction, and Rick, thank you for reaching out to us, allow us to be part of your legislative meeting here. Without a doubt, I know there's a lot of frustration with appraisers across the board, whether it's VA or not. And I can tell you, I do want to. I got an email from a lender. From one of their executives, and I kind of paraphrased because I took out the name of their loan stuff. But if I could just take a second and read what she wrote to her company, and she said, loosely paraphrased, to address your concerns about the operational tempo and specifically our frustrations of the appraisal industry, please take an account of the following. Our underwriter department is working 6 and some 7-day weeks. Loan officers are seeing volumes of loans beyond their team's limits. Title companies are booked solid and are getting cranky. Purchase contracts are getting more and more creative and even exceeding asking prices. Appraisers are working harder and harder to try and value to support these values and often absurd values. And when they're complete, the appraisers, rather than going on to the next assignment, they're being peppered with reconsideration questions. We are not the only ones feeling the pressure. Everyone involved in the real estate are being pushed to their limits. And I was really stunned to hear a lender say that to their company. And I see this over and over again. There's a lot of people getting cranky. A lot of people just getting on edge. We want to move loans. We have lots of loans out there being moved, and they want it faster and faster and faster. And that goes to every part of the industry. I'm sure your title companies, they're booked. Try to get those slots so you can get them closed, are getting harder. But the appraisers are feeling that pressure as well. We know our appraiser times, which I would have to say we're the only industry or the only agency post our times openly. There's no other AMC to say, here's our turn times for our appraisers. They have contracts with lenders where there's a target date. But even AMCs, I talk to the AMCs quite often. They're seeing their fees increasing where they can't meet their contract obligations with their clients. They're extending their time, extend times are being extended. I've been even approached by chiefs appraisers of major bank lenders and asked if they can run their how we can figure out, can they run their conventional loans through our VA panel? Because in some places, we're able to provide faster turn times at cheaper fees. Why in other areas, obviously VA, we're not competing. And so this is a stressful time for appraisers to be in. And I really, really feel for any lender working in this environment. We're seeing crazy contracts. We're seeing asking prices, bids on contracts, 25% over asking price. And those are just crazy amounts. And it's very difficult to find support for that. As an appraiser, as a chief appraiser, when you talk 25% over asking price, I always kind of ask, do we believe that the listing agent listed below what they thought they could get? I think they were aggressive in their asking price in the first place. So there's just a lot of pressure, and I don't have a lot of answers to come to you and say, we're going to be able to fix it. We are looking at our fees. The one thing that we are looking at is a lot of lenders are offering rush fees. They're offering more fees to get theirs to put ahead of someone else's. And that's something VAs typically have never done. We've typically always said that we shouldn't put one veteran in front of another. Just because a veteran may be a retired colonel and can afford a rush fee versus an E3, they can't. And so we want to treat everybody equally. We always kind of told our appraisers to be a first in, first out process. I think it's the most equitable way of doing it. We are opening up recruitment. We are trying to recruit in a lot of our areas. For instance, I was just talking to some appraisers in El Paso, Texas. It's a really hot area for VA. We need to recruit. One of our appraisers is 90 years old. He was pronounced dead on the table 2 years ago, and he's been turning down $900 and $1,100 fees because he only does VA, and he does 2 a week. But at 90 years old, that's all he could do. And that goes to I think that says a lot about our appraisal panel. We have a lot of appraisers who have been on VA panel 30 and 40 years. They're quality appraisers. They love VA. They love working veterans. And for our appraisal volume, which is not the same as our loan volume, because we don't do appraisals on IRRRLs, 650,000 appraisals we did fiscal year 20. And that's a lot. And why, when you exceed more numbers, you get more issues, more complaints. When you're at lower numbers, you see lower issues, lower complaints. So we think it's equalizing. We do want to listen to those issues. I do appreciate listening to lenders and hear your concerns, because I can't get better. I can't get my appraisal panel better unless I understand what you're hearing and seeing. Last thing I want to talk about is the market itself. We are the only agency out there that allows 2 bites at the apple. I do want to just, for those lenders who don't know, I know, Rick, you know every bit of this. First is the Tidewater. And let me just kind of clear the air why it's called Tidewater. Rick, you know it, I'm sure you can explain, but it was a pilot program in Tidewater, Virginia. It's just a name that stuck, and we're sticking with it. It sounds like it's a black ops type operation, but it really wasn't. Jerry Kiefer started this thing there in Tidewater, Virginia, in a high school gymnasium. They had Tidewater High School above them, and he just kept saying, let's try this initiative. And that became the Tidewater Initiative. And I felt it was a good program. They kept it. It started in 2003. That Tidewater Initiative is when the appraiser sees evidence or believes there's no market evidence to support the contract, to just start engaging in communication. And my God, everything in life involves communication, whether it's a marriage, whether it's a business deal, or a real estate contract. It all has to be with good communication. So that's why we believe it's a good program, because it allows lenders and agents and appraisers to start shaking their head north and south. Here's what we see. Here's what we have. There's some delicate lines in there. We can't talk about assignment results, because as if I was Rick's appraiser and Rick was my client, we could talk about assignment conditions, but I can't talk to it about other parties, because because we have client confidentiality by USPAP, the Uniform Standards of Professional Appraisal Practices set by the Appraisal Foundation, sanctioned by Congress. So it's our official document rules that I have to keep client confidentiality. The homeowner is not my client. The builder is not my client. The real estate agents are not my client. If Rick was my agent, if Rick was my client and my lender, he's my client. The VA is my client. So under Tidewater, we shouldn't be talking about which comps did you use. That gets borderline. Me as an appraiser, I'd tell Rick all day long what comps I used. I just would not convey how I adjusted them or how I'm looking at them, because I may not be even finalizing my value. So we want agents to provide professionally comparable sales. We often see agents, real estate agents, provide a comparative market analysis. Well, that just tells me a CMA and a market analysis is really in the wheelhouse of what appraisers do, not what agents do. Agents pull a CMA so they can kind of navigate what they need to do. But when you're doing a market analysis, that is strictly in the wheelhouse of the appraiser. What the appraiser is asking for, show me 2 or 3 sales that are comparable, not to use word comps, that's what we call it in the industry, but show me 2 or 3 comparable sales that support my price. They don't have to exceed the price, because we understand here's a house that's very comparable, it's a little smaller, and when you factor for that, it might support your contract. It always comes down to the key word is show me, as an appraiser, show me one home. In this market, show me one home that's comparable that can help me support your contract. Don't tell me price per square foot, because we all know typically smaller homes have a higher price per square foot. Typically, 1-story homes have a higher price per square foot. So when I got a larger 2-story home, what the agent's going to give me are smaller homes or 1-story homes to help me with the price per square foot. And that logic just doesn't work. It has never worked. It hasn't worked in the 40 years we've had licensing or appraising. And appraising's been around. If you go to Rick's, the Royal Institute of Chartered Surveyors, appraising's been around since the 1700s. So the methodologies, show me 1, 2, 3 homes. If you can't prove it in 3 homes, you're not going to prove it in 30 homes. 1, 2, 3 homes. Here are 3 solid comparable sales we would like you to consider. So that's the first bite at the apple. And we want that to show everybody. We want our appraisers to communicate professionally. I hope our appraisers are communicating professionally. And if that doesn't work, if it doesn't support that value, the appraisal gets turned in. The second bite of the apple is the reconsideration evaluation. The ROV process should come from the veteran first. The veteran should be aware of the value, and the veteran should say, do you want Rick, or do you want the lender? Do you want someone to contact the VA to request a reconsideration of value? And the reason why it has to come from the veteran, because the veteran may be fine with that lower value. Maybe the veteran's looking at it and say, I think the appraiser's actually looking out for my best interest. I felt maybe the veteran felt uncomfortable going $50,000, 15% over the asking price. And maybe that real estate agent is not supporting the veteran the way they should. And so that lower value may be what supports the veteran the best. Now, unfortunately, it kills the deal. And as lenders, I know that's horrible. That just everybody's at a loss. Everybody has time invested, and no one gets paid on it. And we don't like that. I will tell you, as a veteran, I like it when the veteran says, I'm happy that the appraisal is taking care of me. And I feel if they feel they're in a better position, I'm concerned about my customer service and my veterans experience. And if my veterans experience feels that VA took care of them, that's what my goal is. So we may not always align that way, but I hope you understand our focus is our veterans happy? So the second bite of the apple, the ROV process. If the veteran does shake his up and down, say, yes, I want this house. The appraiser may have missed the value by a fractional percent. It frustrates me as an appraiser, frustrates me even more as the chief appraiser. But I know you see those appraisals come in $1,000 or $1,500 off mark, and it just makes my blood boil. Those are the easy wins for VA. Those small marks are easy for VA to overcome. We need to be a little more timely. I don't like the fact that our ROV process takes a few days. We want to be a little faster than that. We're working towards that. We're looking to automate it. So when Rick has an ROV process come through his shop, that those lenders will be able to just automate the process, put it right into the web portal. We can capture it. We'll see it almost in real time. And we do have some automated technology coming. We're working through solutions. I just had a meeting with my contractors today. We are working on how to set that system up and try to get those, and I call them quick hits, those quick fixes. $1,500 below contract to me is a quick fix. We should do that within a day or two. And those are a lot of wins. But let's talk about the bigger issues. When you're asking 15, 20%, that takes a lot of our VA time. That takes a lot of taxpayers' time, money and time. Often sending people out to the field to go look at the properties. So there's government expense for a government employee, vehicle. If it's, God forbid, if it's in Upper Maine, because the closest person we got to send is now overnight. So now I got to call my valuation officer, Marty Finland, great guy. And I got to tell him he's got to send his SAH agent all the way to Upper Maine, overnight travel, to go look at sales that we know off the cuff are not comparable. So when lenders are asking for, or a veteran thinks that they need a reconsideration value at 15, 20, 25, 30%, really need a lot of due diligence to make sure we are asking for the right value. Well, there's two bites at the apple that we have pride in, that we have the authority by Congress to do. We never override, we never alter the appraisal, because Congress has given us the authorization to issue the NOV at a different amount than the appraisal. It provides protection for the lender. It gives us the authority to do it. And it's something that works out. Fractionally, we see them coming through the door, but we're doing them 6,000 to 7,000 times a year. So not that I'm beating the drum, I want to do double the amount, but we should do double or triple the amount, but we need to do it in a third of the time. And so I really, really encourage for your lenders to understand, to look at those options. There are options that are there to you. It better serves your client. It does a better deal at holding the deal together. And trust me, as an appraiser, even as a government employee, I'm often on the phone 8, 9 o'clock at night with real estate agents trying to hold the deal together. That's not what I do. That's not really my wheelhouse, but it's in my passion. And I hear, hey, this deal's about to fall through. It's taking too long. Let me get on the phone. Let me call lenders, real estate agents, appraisers, say, what can we do to keep this deal together? Because I want to see every veteran to get the opportunity to buy a house. Last bullet I want to talk about. This is my last bullet, really, and we'll take some questions. Veterans are having a hard time getting offers accepted. We know this. You hear this. We hear it all the time. If you talk to real estate agents and just ask them, what's the first offer you're always going to take? Cash. There's always been this precedence of order. You're always going to take cash first. Conventional has always been second. When I was a real estate agent representing a seller, conventional was always my second place. 20% down, you're golden. That's the easiest way to go through. Government loans have always been in third place. Not VA, not FHA, government loans. Because now you're kind of talking who's going to make the best offer. Often we see it's the real estate agents that don't know how to sell that VA offer. We often hear that a VA offer, there's no skin in the game. They're not putting any money down. But when that real estate agent says, you know, when that veteran raised his hand or her hand and put their life on the line, that's their down payment. That's how you sell the loan. That's how you sell the offer. If you don't know how to sell your VA offer, then you need to get out of the business. And that's just my opinion. You need to know how to sell. You need to advocate for your buyer. If you can't advocate for your buyer and convey to the seller, VA has the lowest foreclosure rate of all loans. And if you want repeat customers, sell to those who have success in keeping their home. If you don't know how to sell, I've seen real estate agents bring the veteran by when they know the homeowner's home, so they can see their kids, so they can see, hey, this is a family. So to get a VA offer in is very challenging. It's not the veteran. It's sometimes the appraisal. Sometimes it's the MPRs. Sometimes it's the no money down. Sometimes it's the fees that they have to spend. It's a lot of different things. Bottom line is, how does that agent sell to the other listing agent? You need to take my offer. So that is a problem. We know it is. It's a seller's market. When times change, and we know that they are, when it becomes a buyer's market, VA offers now are not the issue. So that's all I wanted to bring up. That's all I really wanted to talk about. I do know, as I know Rick and many agents, they have a lot of questions about appraising and valuation. And look, I don't, and sling them. I'm thick-skinned. So if you got darts, fling them, because that's how I get better.
We won't throw any darts at you, James. All right, we won't throw any darts at you. But I wanted to thank you both for your presentations. We got about 30 minutes left. I've written some questions down, some commentary that maybe will precipitate some discussion. And so one thing I want to start off with. This is probably directed to Terry. It's more policy. And you know, I've talked to my dear friend, Deputy Director John Bell, many times, and it blows me away that Fannie Mae and Freddie Mac are the two AUSs that decide whether VA loan goes forward, it doesn't go forward. I know that, you know, from an automated underwriting system perspective, I know that there's been conversations in VA in the past about a VA-orientated AUS. Can you give us any sort of insight? Is this on the radar? Is this something that is whiteboarded? What can you kind of fill us in on that, Terry?
What is that? No, I mean, we've had tons of conversation on how we can implement an automated underwriting system, what that would look like, and how it would interact with our other systems that we currently have, and what we're trying to do into the future. So certainly it is a topic of conversation quite frequently.
That's awesome. Good. So yeah, it's funny. You go one way with loan, LPA says, no, it's not a good VA loan. Then DU says, yes, it is a good loan. And then sometimes they flip flop. And I've had conversations with John and Mark Jameson when he was around, and I hope he's done. I heard he's doing better, and it's like, well, why they denied that is beyond me, because that's a good loan for us. That's a good loan for us, but another AUS or GSE is saying, no, it's not. So that's good. So, James, I wanted to touch upon real quick, sort of this discrimination of veterans by real estate agents, right? Great points that you hit on. I see it a lot in Massachusetts. I know a lot of our mortgage professionals on this call see it across the U.S. My question is, has there been any conversation between valuation, your division, and NAR on precipitating a better sort of top-down distribution of education to the realtors? Because what you know as well as I do, right? What we have are the 40-year agents that have been doing this for 40 years that know everything, but you can't teach an old dog new tricks type thing. So what kind of conversation, or are we having conversations with NAR about this discriminatory practice? Because it is, it's pretty bad.
So I'll tell you, Rick, we have talked to NAR DC. NAR DC is a great organization, but that information doesn't get down to the 1.3 million real estate agents. And so it's really by any time I could get in front of a broker in their pool of agents, I raise my hand every single time. I do it. Southern California, we just had a VA rep had a conference, and we tried to get out there as much as possible, because it's old monkey see, monkey do. It's what they've been told by their broker 30, 40 years ago, and it just keeps trickling down. One of the conversations on the side was, why does the seller care if there's no skin in the game? NAR has done a survey, and that's what several tens of thousands of agents came back with, that their sellers, and they say sellers, again, as an agent, you're coaching the seller. Hey, here's what I think you ought to do. And when I have a seller, a lot of people look at cash down. If you're putting 20% down on a conventional loan, that you have some buffer room in the event that the appraisal doesn't come in, and they know that there's a lot of earnest money. They don't get to walk away. There's no escape clause. So conventional has always been, historically, the second place to cash. And, they could start waiving stuff. Interesting little conversation talking about agents. Last group I talked to, a group of RE/MAX agents talking to the broker, it's sort of like what we were before the conference started. And I asked the broker, I said, how's your business doing? It said, there's more agents than there are homes for listing. And he told me something interesting. He goes, I no longer have my agents represent buyers. And I was like, why is that? He goes, in this market, the only way I could get a buyer to get the contract accepted is to go over asking price, put a lot of money cash down in the contract to waive the home inspection, and then hope that we could get an appraisal waiver. He goes, those are the 4 big ticket items that we have to support our buyers, is to not go over ask price, to not put cash down, to get a home inspection, and to get an appraisal. He goes, when I waive all 4 of those, I'm not advocating for my buyer, I'm advocating for my commission.
That's a great point. That is a really good point, actually. That's pretty dynamic for an owner of a broker shop to do that. And I commend them, because it is, at the end of the day, the mantra of VA is protecting the veteran service member and their family with this benefit application, right? So I had a great question from Vernon Morris. Can VA work like conventional, where the company can order the appraisal and not have to go through VA? So I know that there's no way to do that, but you can certainly answer it, James.
So no. So we're bound by Congress statute. Congress told the secretary we are to use our panel of appraisers. Now I will tell you, as an appraiser, here's my educated opinion between the two. AMCs are a bid process. They want the cheapest and they want the fastest turn time, which in a lot of ways, who doesn't want the cheapest and fastest? But between quality, price, and speed, you can't get the best of all 3. And I think that if you really wanted to say, do you want someone who's honest, or do you, and give you just the value on the AMCs? If I give you a lower value, that only works once or twice, and you no longer get orders. You get that little asterisk by your name and say, this appraiser here does not play well.
Mm-hmm.
They still have undue pressure. That's been the whole process. I understand there's always been this dynamic between lenders and appraisers, has been for decades. But we're the independent one, and we're not against agents. We're not against lenders. We're not against anybody. We just want a true value. So I do believe that in this world of AMCs that stemmed from HVCC, which, by the way, HVCC had frequently asked question number 23 on Fannie Mae. FHA and VA never had to apply to HVCC.
That's right.
But in the world of AMCs today, there's still a lot of pressure to turn it fast, turn it cheap, and regardless of quality.
And I think it's important for all of our mortgage professionals on this call to realize that VA, and Terry would be able to elaborate on this, but VA is really governed by two things. There's law, there's federal law and the CFRs that it's codified, and then they have policy, which is our handbook, 26.7, and the various chapters in which we kind of operate. So sometimes, literally, guys, Fannie Mae and Freddie Mac can make a change to any LLPA or guideline anytime they want, but literally it takes an act of Congress to make drastic changes to the VA benefit.
Well, and to add to that, Rick, there's CFRs and then there's statutes.
Yeah,
so
correct.
CFRs, we could change those. It's a long time process. Statutes is the Congress telling the secretary you will. CFRs is the secretary saying, here's how I am. So when it's statute, it's a congressional change. We could change CFRs. It's still a lengthy process. It's a legal process. And our appraisers are also doing conventional and FHA.
So another question was, in California, this is from Guy Schwartz, California VA loans are rejected due to termite issues. Now, that's obviously an MPR, minimum property requirement for VA. Let's talk a little bit about not necessarily waiving that MPR, but there is a process to waiving in some MPRs. You can request it. It's not a common thing, but I've been very successful. By the way, Marty Finland is one of the best VOs. I love that dude. I talk to him all the time. And real quick, mortgage people on our call, VA wants you to call them. Like VA RLCs want to speak to the people in the field to help veterans, right? So I talk to Marty and I drive him crazy. But let's talk about MPRs and maybe a waiver from time to time, because I think that's an important thing to talk about.
So termites are a difficult one because termites are really a destruction of the home. And so here's just my viewpoints on it. One, I got to protect the secretary. If we get this house back, I don't want a half-eaten house. I don't want my secretary going, what the heck do I got here? My veteran, I don't want my veteran going there and say, hey, my bedroom just collapsed. And then you got to look at the seller, say, do you think you have termite issues? Is that you're hesitant? There is the termite fee, and there's some misconceptions that the veteran has to pay for their termite inspection. Then and I'm going out on the lending world, and Rick, I don't ever want to do loans, just like I don't want you to do appraisals. Okay, so if we can agree on that, we're good.
Okay.
But I think you can take that fee and wrap it in someplace. I think I think this is, again, I'm the appraiser. I'm not the lender underwriter. But can't you take that termite fee and put it in the allowable cost? I do know veterans, you don't want to come out of pocket a lot of stuff on a home you don't own yet. But the termite fee is something, the termite inspection is something we are looking at. How can we get this into a more flexible area?
Well, there was a circular in May of 15, which recategorized the pest inspection as a non-allowable. So if it falls under the 1% non-allowable, so the veteran can pay for it. I know that there's always a rescission period on the circulars, but we could maybe add it to the state deviation list.
And then we got people like in North Dakota, they don't have termites. So they're exempt from that termite place. Hawaii, Puerto Rico, Florida, real high in termites. And so we want them to have a safe house. MPRs are very vague. I talked to the past chief appraiser, Jerry Kiefer, who had this job for 26, 28 years, great guy. And the advice that he's given is, as soon as you write that box, as soon as you write out that script of here is and here is not what an MPR is, I've kind of boxed myself in. I know I am looking to take my policy and peel back a lot of these requirements. There's a lot of requirements I've imposed on the policy on both lenders and appraisers that, looking back, it's not a government position. I will tell you one thing that we're in consideration. This is a consideration we have on topic, is road maintenance agreements.
Yes.
Covered by a lot of states. It harms. The worst case scenario, it's a $2,000 fix. If the secretary takes the house back and the road needs grading, It's a couple grand. It's not huge, but it's a huge issue to do. Attic inspections and crawl space inspections. I don't know that an attic inspection has ever saved a veteran, protected a lender, or the secretary. There's no data to support this. It's an old FHA item that we've had since the 60s. I just question now. I look back and question, say, what evidence-based decision to make policy do I have to keep that in policy? So we are looking at the termites. We are looking deep in our policy and say, what can I clean out?
That's great.
But Rick, this goes into part of your other question about an automated system. You do need to have, clarity in policy, and you need to have a streamlined policy to allow an automated system to perform to the way that you want it to perform. If you have a lot of these, like the NPRs and other rules that require someone to look at those and to slow down that process, that hinders the automation piece. So those, as James mentioned, there's a lot of work that has to be done in our policy and our handbook. We recognize that, and as we continue to build our departments and to grow out the FTEs that we're hoping to do in the coming years, this will enable us to start to look at policies a little bit more closely, start to redefine some of those that are either outdated or don't fit within an automated system. And so those are a lot of work ahead for us, but those are things that we're looking at.
I mean, so I have been the revamp of chapter 4 and 6 and 10 last summer was awesome. And the year before, it was 2000 anyways. That was great. And I think what a lot of mortgage professionals need to understand is the fact that the VA, I call it the VA loan, is a story loan, because that's why the handbook, I look at the handbook, and the lack of having hard and fast black and white is what makes the VA handbook so awesome, because we want to close loans for veterans, but it's got to make sense. We can't put them in a bad position. And the handbook allows us a degree of ambiguity outside this gray area where, all right, well, they don't have this, but they have these 7 other things. And if we do a black and white, kind of like where you were going, like we have a black and white, that we don't want that black and white hard. We want to be able to elaborate and tell a story. So that's why I love VA so much. We got a few more minutes for, and I know you got to pop off, Terry, but
I do.
I got a call from I'm an idiot. I got a question from a Mr. Brian Phillips. He said, I was on a call with VA rep, and James mentioned approximately 13% of the appraisals are having Tidewater invoked. I would love to know what percentage of those 13% receive additional value as a result of the Tidewater initiation, and what percentage of those receive additional value from the ROV. Do you have any data on that? No.
I have data on Tidewater, I have data on ROV, but they're not correlated. And that's one of our issues that we're working with is when we automate the ROV, now we'll be able to touch it for each loan. So for every VA loan, we'll be able to see what that process is. Once we get that connected, we'll be able to import that data, and we'll be able to track how well they're correlated. So I don't have that direct answer, but I will say, talking to, not gonna say name, talking to Freddie Mac up in the upper divisions of their valuation area, they're seeing a higher percentages of their conventional loans not making value. And they told me in Miami, of all areas that they just supported up Miami, 38% not being able to support contracts. This is something that's never been talked about. Just as like we never really hear any numbers about FHA. How many times does FHA not support the value on a purchase? Then that loan, that house is stuck with that number for 60, 90 days. So there's sometimes VA, I don't mind taking the black eye when we own it. But I do want to say that we're the only agency that's laying our stuff out there. We lay out our fees, we lay out our timeliness, we're open and transparent. Jeff London demands that of us. We want to be open and transparent. But we are, as a government agency, we open our doors and say, here's our expectations, here's our fees, here's what we do. And because of that, we do get punched around, and sometimes rightfully so. I can't defend VA. I want to defend VA, and I want to defend my industry. We can always be better. We always want to be better. But we are the industry that lays out. If you want to know our timeliness, Google it. If you want to know what our expected timeliness is, Google it. If you want to know our fees, Google it.
It's out. I mean, you know, guys and gals on the call, you can go to the VA lender website page, grab all of the production reports from the state per state by lender, volume, purchase, earls, cash out refi. They throw all their data out there. I will say one thing about working in the VA sphere for as long as I have, the transparency that they have is just phenomenal. I mean, they encourage you to speak to them, call the RLC, ask for a loan analyst. Mark Connors, who is a phenomenal asset to VA, he's the lender liaison officer. He's always encouraging you. If you don't get the right, don't go to the top. When we have a hierarchy here, guys, if you go to a question, you have a question on a loan, I'll give you an example. Holly is the LPO, loan production officer in Cleveland, and she is phenomenal, right? We had a question about a various form of income in Massachusetts. I disagreed with my underwriter's interpretation. They were calling it foster care. Foster care is not allowed to be income in VA, but I felt this wasn't foster care. I provided all the data, went to the loan analyst. The loan analyst says, nah, you know, I think it's still foster care. I respectfully requested to go to Holly LPO. We looked at it, we talked about it, she did some research, I did some research, and she agreed this is not foster care in the sense that it's actual income, it's the per diem income that the individual received because their daughter was severely disabled. So it was a phenomenal conversation, and my underwriters were like so pumped about having that guidance. So guys, we can talk to VA anytime we want, and I encourage you to reach out to your RLCs. We had a question from Hawaii. So lava zones, Terry, hot topic. What can you tell us? I'm not from Hawaii. I don't know anything about lava zones, so I'm not going to pretend to do that. But so you can kind of give us a little 411 on that. That'd be great. James?
Terry, I could add to that.
Yeah, I haven't been in the Hawaii space in a while.
Well, you know, it's funny, Terry, I was looking at James's video, and your name is there still. So it's like, James, give me some lava zones, buddy.
Yeah. Hey, Rick, before he gets into that, I do need to run. I've got another meeting.
Yes, sir.
Again, appreciate the conversation and the opportunity to talk to everyone. Look forward to doing this again. So
I know. I speak on behalf of NAMB, and we all say thank you very much for attending. And good luck on your next appointment.
Thank you, sir. Take care.
The lava zones. If it could be insured, we're not going to have an issue with it. I mean, that's really how our policy is written. You know, there's a lot of lenders that just don't allow homes in lava zones to be lent on. We looked at it. If you could get it insured, VA is fine with it.
Good to know. So if you know that question came into us via our lobbyist Roy Deloach. So if there's a Hawaii LC or mortgage professional on it, hopefully that answers it. So just to recap, James, if the individual is able to get insurance on the property, then we're good. Yes.
Yep.
Done. So
I thought that was a simple approach. If it burns down, if someone's going to pay out the claim, then why would we care? Rick, if I could just add two things that really just came to mind that we haven't talked about.
Your platform, man.
Condos. Now, let's just take a second, and I do want to say what happened in Florida is shocking.
Shocking.
I can tell you, texting last, at night, early in the morning with John and Terry going, my God, first of all, our hearts went out to say to the folks. Our second thought was, do we have any veterans in there? Is that condo approved by VA? We looked, it was not approved by VA. And then I can do a little drum roll. We are in Wavertown. Jeff London and I and John Bell have looked at why are these condos being disapproved, and are we protecting veterans or are we harming veterans, not allowing them to choose to live where they want to? So in the CFRs, we found that Jeff London has the authority to waive if a condo is denied, or if a condo is found not to be compliant. Got to be careful about how I say this. We're in a regulatory meeting. If a condo does not align with the VA CFRs, Jeff London has the authority to waive it if he sees fit. So a veteran does have to, if they're buying into a condo it's not approved, they do have to go through the entire paperwork process to go through our national practice group for a recommendation. If they find this not aligned with our CFRs, we will ask the veteran lender, do you want us to submit a waiver in your behalf? We're turning these waivers around in 2 days, 2 to 3 days. I know my staff has 1 day turnaround policy. Jeff London, the executive director, is up 9 and 10 o'clock at night approving these condos same day. So we are approving condos at a cyclic rate, and we're doing it timely. We find that the majority of the condos are denied, that they don't align for short-term leasing agreements, which we all know any single family home in a PUD has almost similar leasing agreements. And so why are we separating out? You can't buy a condo because of a short-term leasing agreement, but you can buy a townhouse or a home. And we're just harming veterans. And we are in the mode of empowering veterans to choose to live where they want to, not to hinder them.
I just want to add that I'm in Boston, guys. For those of you who can't tell by the way I talk funny, but almost 35% of my properties are VA. I mean, are condominiums. I just had 3 condos approved, James, out of the, I'm not sure which RLC did it, but 2 business days. I submitted it on a Wednesday. It was approved the following Monday. And that was 3 separate VA submissions to the electronic, to the electronic portal, right? So you guys are crushing it right now as far as getting these condos approved. And yeah, you know, the 2 biggest things that I ran into as a condo guy in Boston was leasing restriction was the big one. That was the big one. And I know you guys are working. I haven't had a waiver yet, but I haven't had to. But,
Waive it.
Yep. And we can save it now. And the other one that we sometimes run into, and this is, I guess, very common in Florida, our first right of refusals. And that's a deal breaker. But I mean, no, not anymore. Really?
Waive it.
You guys are going to waive first right of refusals in certain cases? Wow.
No, we see most of the time, Rick, we see veterans already living in there and doing a refinance.
Wow. I didn't know. I mean, I was always under the assumption that was it's no kidding. That's new. I didn't know.
We still see lien position. That's not waiver. Obviously, secretary is going to be in first lien position. There's four main CFRs: alienation clause, first right of refusal, short-term leasing, and I'm going to have to make up the 4th one because I can't recall it off the top of my head. We just don't see it a harm to veterans if the veterans understand it. If the veterans like, I accept it as is. And let me tell you a quick little story, not to be chit-chatty, how this came out. It's a great little story. We had a veteran who out-survived his wife and kids, living in an apartment. They're raising the rate because rental rates are going through the roof. But he could afford to go live in a condo, but it wasn't approved. It was close to the VA hospital, which he needed to go see. And he said, 6 months, I will be on the streets because I won't be able to afford my apartment, but I can't afford a condo. It's just not approved. And I can't afford to live in a townhouse in the same complex. Either we make this veteran homeless in 6 months or we waive it. And Jeff just said, this is an easy decision. Waive it. Done.
I love VA. You guys are just like, you know, that's the beauty of what you guys do is that you actually, unlike, I won't mention any sort of GSCs, but other GSCs don't see things the same way that VA does, where VA actually wants to put people in houses and make exceptions or concessions around certain situations. And that's why I love working with the VA law.
Every one of those flags behind you, Rick, represent a veteran.
Sure does. This is the
Not
Massachusetts.
alone.
Yep.
That's not a portfolio. That's somebody who raised their hand and took an oath of office.
Yeah. Yeah, this is our Massachusetts Boston Common event. I did it for the last 7 years, and That is 37,200 flags that we plant in the Boston Common to represent all 37,200 mass soldiers killed in combat since the Revolutionary War. So I do that every year right around Memorial Day. So
Awesome.
so that's awesome. I didn't even know about those waivers. You know, the last thing that I want to throw out there, you know, something that NAMB has been working on, James, and, you know, I know you're not the guy to kind of, but VA, veteran protected class we're trying, NAMB has been trying to move this along through Congress for a while. We've been, you know, Roy is a phenomenal lobbyist of ours, President Kimber White, previous president, past President Rocky Andrews. It's always something that I just want to let you guys know this is something that I know VA Rep has been working on this very carefully. There's only 6 states that where veterans are a protected class. Massachusetts happily is one of them. You know, if there's ever a way that VA could work with a 501c6 nonprofit and give us some help, we would really appreciate that, because I think a veteran protected class may help combat some of this discriminatory actions that we see in all, you know, in the other states that are out there. But you know, that's something that's on our radar. I wanted to let you know that, and I know. But if there's ever any data you could provide to us, it'd be great to help us with that fight, to help you guys.
I'll let John know.
Now we're at 1:10 here. If there, does anybody else have any other questions? You can hit the chat box. You got the chief appraiser for VA here for another 5, maybe 10 minutes, and you guys can ask a question on something, anything, maybe not personal to James, but
Hey, until a question comes in, let me just kind of throw something else out there, what we're working on.
oh yeah, what do you got?
Getting this through, we have to get the PRA, Paperwork Reduction Act, which has nothing to do with reducing paperwork. Contractors, my contractors solution team, our vision that we're hoping to build out 9, 10, maybe 12 months is a new process of when you order an appraisal. It's going to be a new 1805 form that's going to be much simpler, cleaner, and easier. And then as a lender, you're going to be able to put in contacts. If you want both real estate party agents on it,
This is awesome.
and the veteran's email, guess what, Rick? Now through the entire appraisal process is going to be tracked, and they're going to get notifications. So when you first order it and the order is placed and it gets assigned to an appraiser, everyone that you as a lender list that you want to be as a point of contact to the transaction is going to get notified. The appraisal has been ordered. The next is when the appraiser goes to acknowledge it, says acknowledge it, and I got it, so you know the appraiser is alive. Everyone that you list on there is going to get an acknowledgement. They're going to get an email. Hey, the appraiser acknowledged that they got the order.
It's awesome.
When he sets the appointment or she sets the appointment, everyone's going to get that notification.
So that is huge. And one thing I will tell you, one thing that I do run into quite a bit in my market up here is we are finding there is a little bit of a delay on appraisers reaching out to the point of contact. And I think some of our appraisers in New England could use some re-education that the 10-day delivery is actually a 10-day delivery, not 10 days from the date of inspection. It's 10 days from the date that you accept the order. You know, I know we're all busy, right? But if you can't deliver, you're not supposed to accept the order.
That's right. And that's all going to be in there. So also, this was a little bit of pushback. When I went to the appraisal industry, said, I'm also going to require that when you get done from inspecting the property, you have to go, and it's going to be a push button. There's no more free notes. They're going to go in there and say, click a button. I inspected the property. I'm back and I inspected the property today.
Wow.
Because appraisers are like, you don't trust me. 99% of the appraisers, when they set the appointment and they get it inspected, they inspect it that day they said. But what I don't like is when your bosses ask you, Rick, and say, hey, did the Smith property get inspected today? I don't want you to shrug your shoulders, say, well, they told me they were. I want you to be able to look in your computer and say, yep, the appraiser said, I got it right here. The appraiser inspected it. And then there's going to be the file upload and the NOV are the two oddball ones I need to work out. Not sure if real estate agents and veterans need to know that, because I know as soon as the appraisal is uploaded, that means you're going to start getting more phone calls. And there may be a delay or lag in what you need to work out. But what it is, it's going to be a very automated way, very transparent way. We're going to build you a dashboard, Rick. So you'll be able to look at all your VA orders. You'll see where everyone is at in the process.
That would be so huge, because then we have what I think is so important in our business is the accountability piece. You know what I mean? Because that, you know, it's so easy to sort of manipulate the notes, the system, whatever. And, you know, Brian Phillips just asked another question, and I'm pretty sure I know the answer to this, but James, is the date of appraisal assignment and the date of acceptance viewed as the same date? It's the same date.
Let me add another piece. So we're going to drive values, appraisal values, and appraisal prices and timeliness down to the county level. And Rick, the reason why I'm going to do that is because I think at the time, I know you're not doing it. You probably got this huge old team doing it for you. Let's just say you're going to order the appraisal yourself. When you put in the address, the county, and the property type, it's going to tell you, based on the property type in the county, the base fee is this, and here's your expected turn time. Now, if you're in Massachusetts, obviously you got a large pool of appraisals. That's going to be, your turn time is going to be 1. But if you're in a rural area of Massachusetts, and maybe the turn time is 25, 30 days. Well, if that's the turn time, I'm sorry, but if it's in rural North Dakota, well, that's, at least I want you to know what's honestly expected so you can start planning your closing. We're not all, one state, Texas is not all 10 days. Bexar County, San Antonio, they're more 7 days. They're turning their reports in 7 days. So why not just tell you it's going to be 7 days? But if you're in a rural county of Texas, it might be 22 days. Let's just call it what it is. But I think it's important to know then and there, when you're ordering it, you know exactly what to expect. And so we're going to drive that data down to the county level, and you will get that. As you order, it's going to tell you, and it's going to populate it on the 1805 going to the appraiser. Here is your base fee, and here is your delivery date.
That's huge. I have one more. I've got a Hawaii question. Can we get USD? Well, we don't have any say over USDA. So Barbara's question was, can we get USDA to accept VA MPR versus FHA property standards? Can we get VA to help so that Lava Zone 2 on Hawaii Island can be reopened for US? I don't really think there's a lot of work that we can do there, Barbara, as far as VA and USDA collaborating to sort of do that. VA, they're in their lane, and that's the lane that they're in. But I you know, this is all new to me because I don't have lava in Boston.
So, Rick, I think we need to go to Hawaii, meet with Barbara, and talk to her.
That's a good idea, James. So we're at 1:15. I think the last 2 tidbits of info, James, I really appreciate it. I know I mean, like I said, I do a ton of VA and I know it inside and out, but I just learned some stuff today that I didn't even know about, and I'm just pumped. So I think with that, our questions are done. Oh, well, here we got so Brian Phillips just wanted to express his gratitude, and he's the education director for the Louisville chapter of VA Rep, and he couldn't be happier for this info, and it gives more details to share during his lunch and learn. So Brian, thank you very much. I just saw our GA chair, John Hudson, pop on. John, if you wanted to say a few things that's great. Roy was just there, but I know I speak on behalf of all of NAMB, James, when I say thank you for this amazing insight. And I hope it empowers our mortgage professionals here to go out and help more veterans, because they earned it. John, what's going on, buddy?
No, we really appreciate that. And James, I actually live down here in San Antonio, Texas, in Bexar County, and we are Military City, USA. So we love our veterans, and we love the VA loan program. So we really do appreciate all the work you guys are doing up there. So just to keep things moving along here, Rick, and great job, by the way.
So James, I think you're free to go, man. Thank you so much, brother. We'll talk to you. I'm sure I'm going to talk to you soon at some point. We're going to get another VA lender conference going.
All right, thank you, bud.
Later, bud.
All right, cool. Well, I'm going to keep us moving along here. Our next speaker, we are absolutely blessed and lucky to have her speak to us today. I'd like to introduce you to Miss Julie Shaffer, who is the Acting Associate Deputy Assistant Secretary at FHA. Miss Julie, I bet you've got a long business card, don't you? She's got a deep background in all aspects of the HUD programs and is now turning her focus specifically on the FHA loan program. Let's see, Ms. Julie, it looks like your camera's a little dark.
Hold on. Let me try to
Yep,
fix
yep.
it. Hold on.
No worries, but oh, there you go. Yep. You're starting to pop up. Yes, ma'am.
right.
Hey, thank you so much for joining us today, and we really do appreciate it. You know, it's great. I love seeing that non-banks, in particular, you know, the mortgage brokerage channel, really has been one of the big proponents of the FHA loan program over the last several years. As you know, I think it's our independent mortgage bankers and independent mortgage brokers that are really out there in the community serving the needs of the underserved. But I'd love to hear your thoughts. You have a lot of latent breaking news coming out of your neck of the woods. Will you kind of kick us right off with the big announcement that just came out yesterday over there at the FHA, and where are we going to go from there?
Yes, good afternoon. So we've been very busy. We have the foreclosure and eviction moratorium that was extended to the end of July. We also issued a mortgagee letter this morning extending the initial forbearance for the COVID-19 and other loss mitigation options for the borrower. So, and stay tuned because we're still working on additional items. And we've been very, very busy. There's a large group of borrowers that need assistance through loss mitigation. And so we're trying to get that policy out. I'll go through. So thank you. You know, as mortgage brokers, you share in FHA's mission of helping people who are ready and purchase a home. And by doing so, you are enabling these potential homeowners to begin the groundwork for building sustainable and generational wealth. As we all know, the playing field is not level, so it's important that we all come together to develop solutions that make it possible for all, particularly those in communities of color, and to participate in many views as the American dream of homeownership. Before I begin to address some issues, I do want to announce that Office of Single Family Housing has a new Deputy Assistant Secretary. Her name's Julianne Joseph. Many of you should be familiar with Julianne. Her most recent role was as Associate Director of Government Housing and Member Engagement at the Mortgage Bankers, and we're very excited that she's here to help us at FHA. So, as you indicated by the first part of this session title, will FHA reduce the MI fee? I know that this is a subject of great interest. We hear it all the time. Are we going to reduce the mortgage insurance premium? So I'd like to take a few minutes to share FHA's current perspective on the reserve ratio of the Mutual Mortgage Insurance Fund before addressing our position on the MI reduction. Since the housing crisis of 2008, FHA has worked hard to rebuild the MMI fund and is now far above the statutory 2% level, which will help protect the fund, especially given the uncertainty in the housing market due to the pandemic. At the same time, we need to make sure we are not overcharging borrowers for risk and limiting access to homeownership. But as Secretary Fudge announced in March of this year, we have no near-term plans to change FHA's mortgage insurance premium pricing. Our continued goal is to ensure the fund has a cushion in the event of a spike in foreclosures and is able to achieve FHA's mission to help people achieve safe, sustainable homeownership. Any consideration relative to FHA's mortgage insurance premium will need to be in concert with evaluating the risk and ensuring that there is quantifiable benefit to the borrower. Interest rates remain at a historic low, which naturally help mortgage affordability. Well, the health of FHA's MMI fund has remained resilient despite the financial challenges faced by homeowners with FHA insured mortgages in 2020. FHA's portfolio has experienced levels of seriously delinquent loans and loans in forbearance. We continue to monitor the mortgage performance trends within our portfolio, particularly related to those homeowners who are struggling financially because of the pandemic. There currently is an FHA delinquency crisis. And as I said, we are issuing policy to try to address it. We are also have the duty to manage risk and the overall health of the fund, while we continue to rigorously evaluate our strategy and work transparently with Congress again. We have no near-term plan to change the mortgage insurance premium price. We've also been asked, will HUD consider allowing the cancellation of the mortgage insurance when the LTV reaches a certain level, similar to how private mortgage insurance works? In response to that question, I'd like to say, under the new administration, we are looking at all FHA programs and policies. In terms of the life of the loan cancellation, we do need to bear in mind that it is a false equivalence to compare it to private mortgage insurance. Once a policy is canceled, the private mortgage insurance is no longer responsible for the losses. Instead, the creditor shifts to Fannie and Freddie Mac, and they continue to charge their guarantee fee. In contrast, FHA continues to be responsible for all credit loss after MIP is canceled. In 2020, FHA estimated that canceling mortgage insurance premiums when the loan reaches 78% LTV would reduce contributions to the MMI fund by approximately $1.7 billion for each year of production. FHA does regularly monitor and model the effects of the MMI fund for various programmatic and economic scenarios. Our most recent modeling from early June 2021 on canceling the life of the mortgage insurance premiums is consistent with previous modeling. Therefore, dropping the MIP payment at 78% loan to value would have the same impact to the MMI fund as a 16 basis point reduction in the annual MIP, with no improvement to the individual borrower's access to credit. Another question that was shared with us was the down payment. Cutting the upfront MIP, borrowers could use a 97% loan to value for first-time home buyers and low-income borrowers. However, they lack the necessary down payment and overpay for the down payment programs. As mandated in the National Housing Act, a borrower must have 3.5% down payment to be eligible for an FHA insured loan. The down payment could be in the form of a gift from a relative, an employer. They can get a state, they can get a grant, another form of a gift from the state. But we do require a 3.5% down payment. FHA has considered that there are hundreds of down payment assistance programs available nationwide. However, we also realize all down payment programs are not considered equal. And we intend to review the current down payment programs primarily used with FHA and assess viability, risk, and benefits of each, as well as the performance data. We will work to find ways to streamline, improve, and expand DPA programs to help credit-worthy households that need assistance to get over the down payment hurdle have options to buy their first home. We also intend to find ways to bring more efficiency to DPA programs low down payment lending. And we will work to ensure that people are given safe, appropriately priced loans that they have the ability to repay. For example, the president's fiscal year 2020 budget request included a $100 million set aside for Secretary Fudge's new initiative. It's the first home buyer assistance initiative, which provides funding to state and insular areas, unincorporated territories of the United States to support sustainable home ownership. The budget also includes funding to pilot a new FHA Home Equity Accelerator loan program that would test new loan products designed to lower barriers to homeownership for first-generational home buyers. FHA will always stand behind making sure that the loans are sustainable and homeowners are put in the best position to succeed and build wealth. Another topic of interest is our recently revised student loan payment calculation. Everyone participating in the conference, today's conference, has seen firsthand that the barriers to homeownership opportunities because of student loan debt. Based on the data from the National Mortgage Database, 36.2% of all FHA borrowers have student loan debt. 45% of FHA first-time home buyers have student loan debt. FHA realized it absolutely had to address its student loan debt calculation policy that may have artificially inflated the debt-to-income ratios for borrowers who are otherwise creditworthy. And we have good news to report. On Friday, June 18th, FHA published a mortgagee letter entitled Student Loan Payment Calculation of Monthly Obligations, which updates the monthly mortgage payment calculation for borrowers with student loan debt who apply for FHA insured mortgages. The updated policy will ultimately allow greater access to FHA insured mortgage financing for those who have student loan debt, including home buyers of color and buyers 25 to 49 years of age, who traditionally encumbered with large student debt obligations. The policy also matches Freddie Mac loan debt underwriting policy and more closely aligns with USDA and Fannie. This policy was a quick win for FHA, the mortgage industry, and for those would-be homeowners who couldn't qualify for the FHA insured mortgage because they were encumbered with student debt. It also removed unnecessary constraints for otherwise creditworthy borrowers, reinforced FHA's ability to serve those who need it the most, including first-time homebuyers in underserved communities. As mentioned previously, FHA is continuing to remove barriers and provide more access to affordable single-family FHA insured mortgage financing for creditworthy individuals and are focusing on addressing housing challenges ahead. As President Biden and Secretary Fudge have made clear, we must address the systemic barriers to achieve fairness and equity for underserved communities, particularly communities of color. To achieve these goals, FHA will, as it's always done, continue to review and assess all of its programs and policies to ensure that we are operating in a way that effectively opens doors to homeownership for those who are ready, while simultaneously protecting the health of the MMI fund. I believe I've addressed most of the questions that were posed to us. So if there's other questions, I will be happy to take them.
Absolutely. Julie, and thank you again so much for being here. I personally love the FHA loan program. I think it's the best program out there for first-time buyers that aren't veterans and living in rural areas, right? But it's still the flexibility with underwriting is fantastic, and it does help get people past the barriers of entry. Couple of things. So I was going to make a funny joke now that I know that Julianne is over there with you. So when Julia Gordons gets confirmed as the FHA secretary head, so you three will just need to sit together at all meetings and just confuse the heck out of everybody.
We'll try.
So, I love all the progressive changes that I've been seeing from the FHA this year. Starting back in January with the acceptance of DACA to make the DACA recipients eligible for FHA financing, the clarification of new construction with the elimination of the early start letter for new homes that are being built outside the city limits as properties, continue to expand outside, because that's the only place to build in many areas. The student loan change that came out last week, fantastic and great for the industry. The next one that I would just kind of throw out there, and I'm curious about, what is FHA doing in terms of condo approvals? We just had the VA on, and they spoke a little bit about, given what happened in, the disaster and tragedy that happened in Florida just this week. But is FHA going to be examining, the condo approval process again? Because we do see in many cases in many areas where, consumers aren't eligible for, the condominium may not be eligible for FHA financing, and the consumer may not qualify for Fannie Mae, Freddie Mac financing, but might need to utilize the FHA loan program.
So, this administration is new, and they came in, they're looking at we had a lot of COVID policy to look at. We are looking at our condo policies. So we will have a team internally in HUD, and we plan to get industry input. And so what changes we could make currently with our condo policy that would make it easier for borrowers, because it is an affordable.
Right.
It's the affordability of condos.
Yeah.
So that is on the agenda for us to look at. We're just not, we're just beginning that. We have many things going on, and we have a high focus on our our COVID-19 policy right now.
Yeah, no. You guys have a lot of moving parts, and definitely busy with all the changes that are coming out in Washington, but that's fabulous news to hear that revisiting the condo policy is definitely, it has its mark on the totem pole.
Yeah, we definitely are. I've been at HUD for 33 years, and we are so busy right now. And that is one of the things we are definitely going to look at, because they are affordable.
Yeah.
And that we're offering it, and it's a safe product for borrowers. So we're going to look to make sure that any changes we make are targeting the right market that we want to target and that are safe for borrowers. But it is being reviewed.
That's fantastic. Another question I have, and this one's popped up here before, and that is, perhaps is FHA looking at revisiting the FHA streamlined refinance program? And the reason I ask, and the reason this popped up, the Wall Street Journal had an article just 2 days ago that was talking about the number of consumers that took advantage of the record low interest rates over the course of the last year and a half. But some of the numbers that came out were a little bit troubling, in that minority families took the opportunity to refinance at half that of white families. And so again, there is kind of that disparity between, who's able to take advantage of the low rates and who's not. And I just wonder if part of that, because we do see it where the FHA streamlined program is great, unless, the consumer might happen to be in a high closing cost state where they can't be rolling in their escrows back into a new loan amount, but even though there still might be equity in the property.
We're looking at all of our policy to make sure, to see what we can do to make sure that, any adjustments that we need to make sure that we are offering an affordable a product, that it's out
Yeah.
there for the affordability. So we're looking at everything right now. That being said, that might not be on the right at the top. We have COVID-19, we have condo, because people keep asking. There's DPA and appraisals we're looking at, the appraisal policy. So we have many things that we're looking at.
Speaking of appraisals, I have that here on my list. Can you dive into some of the specific areas of the appraisal process you guys might be looking at?
So we do an appraisal. We're looking at the appraisals. We're looking into appraisal bias to see if there really is, see what is being defined as appraisal biased, and how do we try to correct it.
Okay.
In fact, we're seeing it. We do a QC of appraisals after the loans are closed and insured. And based on those, we're looking at the results of those and the policy and what needs to be changed and updated.
Okay. Yeah, no, it's shockingly and sad, but some of the numbers truly are out there in terms of appraisal disparities. And so, no, I'm glad to hear that y'all are looking at that. Yesterday we had Dave Stevens, the former FHA commissioner, and he was talking specifically about that. So again, I'm glad to see that is on your radar. I'm just curious about this one too. We had the Department of Veterans Affairs kind of make mention of it, but we still see this in today's hot real estate sellers market, right? Where sellers can basically drive the bus and decide who wants to get buy their house and who can't, which is unfortunate. But we are seeing where consumers that might only be able to qualify for FHA financing, their offers are not being accepted at the same rate as a conventional or conforming financing offer. And I think a lot of that might be due to misperceptions about the FHA program itself, or appraisal inspections and whether or not the property is going to meet. And I was just wondering, is that something that's on the FHA's radar?
It is on our radar. We've heard that. There is a lot of misconceptions on FHA. As I said, I've been here 33 years. I've heard them all. You require all these repairs to be done. We don't require all these repairs to be done. I sold my house once and it went FHA, and they put a railing up on the landing. And I remember going into my boss and saying, this house is like 40 years old. All of a sudden it needs a railing. It's never been there before. This is absurd. I mean, we no longer do that. It was absurd. I was right when I went into him and said, what are we thinking of? This house has been here.
Right.
Are looking at what are our barriers, and we're also doing outreach. Everybody should sign up for FHA info. If you go to our web page at HUD.gov and go into single family, there's you can sign up to get our FHA info. We send a number of them out weekly. If you can't find the link, email answers@HUD.gov and ask for the link for the FHA info. They'll send it to you. You can sign up and get information, and there's training events in there. So we're trying to do FHA 101 for realtors, homeowners, just so they understand our requirements, because people still think I need that railing on my landing, or I need to fix everything. And
Right.
that's not the case. There's a lot of misconceptions.
Yeah, no, that's great. We'll make sure to get that link out to all of our members and say, hey, you guys need to sign up. But speaking along those lines of the outreach, what can we do as mortgage professionals to help us, and help consumers out there?
Well, when we issue the mortgagee letters in there, there's feedback. You can send us feedback from them. at answers@hud.gov. You can always send us feedback on anything where you feel that we're really missing the boat on something. We do look at that and we'll take that into consideration. You know, we have 4 homeownership centers in Atlanta, Denver, Philadelphia, and Santa Ana, and they do a lot of outreach. So, you know, if you're having any events and you want any of them to speak, they do lender roundtables too locally, which maybe some of your members participate in them. But if you can get on that FHA info, they'll tell you when the training is, they'll tell you when lender roundtables are. There's a lot of information when we issue policy, and you can always send feedback to us.
Yeah. No, that's super important. And it's true, you know, just for the folks that are on here and listening, our feedback really does make a difference. I remember specifically, it was, I think it was Mortgagee 2012-03, but there was a mortgagee letter that had come out that was really going to clamp down on consumer access to credit. And your trade association, NAMB, myself, we went to Washington. We met with the FHA commissioner and explained, you know, was able to use like actual evidence and actual loan file cases where this consumer is not going to be qualified for FHA financing because of this mortgagee letter. And within 30 days, that mortgagee letter was actually rescinded. And, you know, that was a great example of the fact that you guys up there at the FHA, y'all really do listen to us as lenders when we have feedback to give. And so we certainly do appreciate it. And again, that's just another reason why everybody that's a mortgage professional out there needs to be participating in the process and supporting their trade associations. And because, you know, you guys, Julie, I mean, you do appreciate hearing from us.
Yes, we are not on the ground. We are not the ones who have that borrower there. We don't know who, you know, whose application really got turned down and why, right?
Yeah.
We're loans that are insured, and we're seeing case numbers canceled, but you're really there and seeing the barriers on a lot of our policies to our program. So hearing from you is really one of the best ways for us to try to look at it, make the policy. Now we have to balance our mortgage insurance funds because we have to keep our reserve.
Yep.
And it's important to us, but we definitely want to hear from you.
Yeah, no, that's super important. Yeah, as mortgage people, of course, we want to be like Oprah and saying, you get a loan and you get a loan and you get a loan, but that didn't turn out so well the last time we did that. So
Nope.
No,
All the stated income and stated, yeah.
yes, no. Well, again, Julie, we're right here on our time. I really appreciate you coming out and visiting with us. And again, you know, I'm just curious, who up there has the longest job title in their business card? Because acting associate deputy assistant secretary of HUD, that's kind of a big one.
Kind of a big one, you know, and then we make all the acronyms too, so. You'll have Julianne, and Julia. You'll have all
Right.
three.
You guys all have to sit next to each other.
Okay.
So, Julie, we really do appreciate it. Thank you so much for your time.
Okay. Thank you.
Absolutely. Have a great
right.
day.
You too.
All right.
Bye.
And let's see here. With that, Mr. Roy, I'm going to kick it back over to you here for a second or two, sir, and tell us where we're at.
Well, I think what we're going to do now is give everybody a 5-minute break, go make your phone calls, etc., and come back. And Audrey's going to, you know, talk a little bit about, you know, we want to remind everybody to look at the polls. We want to talk about where the poll results are coming in at, which I was actually I was surprised with a couple of these. So let's all take a little break, please. And then at 2 o'clock sharp, or maybe a little bit before, please come back. We're going to start with Tony Hutchinson over at the Freddie Mac, and he's going to give us some really insight of what their what new programs and products they're looking at this year. So anyway, is that then please come back, please, as fast as you can, in about 5 minutes.
5 minutes. That's perfect.
5 minutes.
Awesome.
Just take a
Thank you,
little
sir.
break. Maybe we'll have some music interlude here. Let me see what the producers in the cloud can do for us.
Oh, that's awesome.
See you guys.
All right. See you in a minute.
Hello, Audrey.
Right. Is that 5 minutes? That was a quick 5 minutes.
Oh, really?
Seemed like forever to me.
And great information so far from both of our speakers. That was great. I was thrilled to hear that the FHA condo process is on both the VA and the FHA's radar screen and pretty high up on the totem pole. So that is some great news for everybody.
Okay, you can go ahead, Audrey, if you want to talk about the poll a little bit, try to get more people in there to vote
Yep.
on it. And
All
I
right,
was
guys.
surprised at some of the results of that thing and stretch it a little bit. We're double checking the Coconut Telegraph to Freddie Mac. So just keep talking until 2 o'clock. Okay.
I'll filibuster until 2.
filibuster.
That's
Stretch.
8 minutes on the poll. Is that
And
necessary?
I know you can do this.
Okay, so just a big thank you to everyone who has answered the poll questions thus far. Make sure that your voice is heard and log in to, or just click on the poll and answer the questions. And this is what we're asking. What do you want NAMB to focus on? What do you want to spend our time and energy on? And we want you to put them in order. So your choices are, do you want us to work on outlying trigger leads, changing the 3% fee cap, either increase the cap or remove it altogether, removing Fannie and Freddie limitations on second home investor properties and adverse market fees, or expand homeownership opportunities for minorities, first responders, hospital workers, and teachers. And I don't find these answers at all surprising. I think that, I mean, everything I'm hearing every time I talk to any of our members, they want us to focus on the Fannie Freddie, adverse market, second home investment properties. That's like priority 1. And so our poll is certainly reflecting that at the moment. So with all that, sorry, I finished my thought and then forgot that I have to keep going.
Yeah,
So
you're not
another,
done yet.
what?
Keep going. Let's see what you got.
All right, so another issue that I would like you to be thinking about, and let us know whether you're interested at all. If you are on a W-2 and you are a loan officer, how's it working for you that you can't deduct a single business expense? You like that? If you don't like it, will you let us know? Would you like us to work on making some change to that? We're not entirely sure what that will look like, but a simple yes or no to that question would be appreciated. We want your feedback. We want to be working on the issues that matter to you the most. And the only way that we're going to know what those are is if you respond. So please, please, in the chat box and in the polls, make sure you're answering the questions. And have Roy,
Yes, ma'am.
since I've got you, why don't you talk with me? So, you know, big week in the mortgage business. We have been waiting for the Supreme Court hearing to come down, and it did. And what I found really interesting is in the last couple of months, I've heard a lot of people say that Collaborate was going to stay, that the Supreme Court was, this case was different than the CFPB case, and that it was, you know, it was all going to be different. So happily, it went the other way. So now we have a temporary director, Sandra Thompson, and then we have a little list of people who are in the running or who want to be in the running. So do you have any favorites, Roy?
Well, no, you know, the scuttlebutt this morning, or that's the same as rumors.
Right, got it.
In DC is that she's probably going to be the interim director, and then also probably the first pick as the permanent. So those were that's the sort of like the wisdom right this second.
Well, I heard that Mark Zandi wanted his name thrown into the ring, and I'm not sure how I feel about that, considering his role with the with Moody's. But Sandra has a background as a bank regulator. And so does that come with both pros and cons in terms of her being a good pick?
Well, no, you want somebody that knows the plumbing, I call it. And if you look at her background, she actually knows worked for Janet Yellen over at the FDIC, which is important because those two are going to have to work together if they want to change that agreement on the sweeps.
Right.
So bingo. So that's
Right.
why that's a good pick. The other thing that I wanted to mention, and I think I just lost my train of thought too.
No.
You're catching on, Audrey. The thing I was going to say is that she has some immediate powers right now as acting, and she'll do some things. But what we got to do is wait till she's confirmed to see what she does after that. So anyway,
how long is that process? How long will this process take, do you suppose, in terms of?
You know what? It's one of those deal-making things in the Senate, and I imagine that's why you pick a non-contra. You have to get both sides of the aisle have to be happy with the pick. Hey, but anyway, Audrey, I see
Tony Hutchinson.
He's here.
How are you,
Hey,
Tony?
Audrey, what's going on? Roy, what's up? How are you guys doing?
We're
How are
great.
you? How are you?
I'm doing
Well,
good.
let's don't waste any time here. Let's see what Freddie Mac's up to, and hey, Tony, appreciate you being on, and you're always Freddie Mac's always good to the brokers of giving us heads up on what's going on out there. What's the big new thing? But let me introduce you with the formal introduction, if that's okay.
I'll follow your lead, buddy.
You got to do the right thing at the right time, because Tony and I have actually been in Washington quite some time and crossed paths many times and worked for the same group at the Realtors. And so that's why I always kid, there's only about 120 people in the mortgage space, and we all just switch jobs every 5 or 6 or 10 years. And that's pretty much true. Hey, but Tony is the Director of Government Industry Relations at Freddie Mac. He is responsible for establishing and maintaining the enterprise's relationships with industry and keeping abreast of U.S. housing finance policy. His experience in Washington policy areas is extensive. Prior to Freddie Mac, he worked with the National Association of Realtors, Yay Realtors, and Fannie Mae. And so with that quick introduction, Tony, let's throw it to you, and thank you very, very much. And I'll see you around Washington here someday soon here.
Hey, keeping my fingers crossed. They're opening things up, so it'll be time to get out and maybe have a nice glass of some of that brown whiskey.
That's code for we like to get together, and I guess it's all right. I mean, to say, it's normal people thing. We drink bourbon and smoke cigars. And
there you go.
That's
the way you find out what's going on in Washington, right?
That's right.
That's exactly it. Well, hey, Roy, thanks for having me. Audrey, thanks for having me. I'll take a few minutes to give you guys an update of what's going on at Freddie. It's been a pretty tumultuous year for us in terms of our leadership. And I'll talk a little bit about that, and I'll talk about our, where we're heading. The one things that I will stay away from, and you guys were beginning to talk about it a little bit earlier, I can't touch that third rail of what's going to go on over at FHFA in terms of its leadership long term, and then in terms of what's going on with some of the relationships between Treasury and the GSEs. We have to stay away from those. But I would say, keep a lookout on that, because things right now are a bit fluid, as they have been with us. And I will start off with that. At the beginning of the year, we lost our CEO of the last couple of years, David Brickman, as I'm sure most of you all know. That spurred some changes within the organization. One, we hired a president from inside of our organization. We moved Mike Hutchinson, who was in charge of our investor and capital markets group, into the president's role to handle operations as they were looking for a new CEO. And we actually appointed a person from our board, Mark Greer, to be the interim CEO until we actually brought someone on board. We operated in that space for about 5 months. And then within the last couple of weeks, we have our new permanent CEO, a gentleman named Mike DeVito, who came over from Wells Fargo. Some of you guys may know him. Some of you may not, but he's been in the industry for at least 25 years and has a great rapport with a number of people in the industry. Hopefully you guys know him and will come to meet him and then like him possibly. He really has a great respect for what the industry does, how bankers work, how brokers work, and now he's learning about what we do on the secondary mortgage market, and is going to help us to better connect with you guys. And I think that will be good moving forward. So we've had those things going on for us, finally a little stability. The one thing I would say to you all is that even with all of that change, we have still remained open for business, and our focus, and our new CEO has mentioned this, our focus is still going to be on our mission. So trying to do our best to make mortgages affordable. So putting products in place, putting policies in place that help you help consumers get into mortgages. We're going to be doing this while we operate safe and soundly. We constantly have to work in that space, but we're really focused on our mission. And I think we have leadership at the top that really wants to pursue that. And with that in mind, we've undertaken a number of different things. We're still pushing our 3% down product out there. We're not pulling back from that. We're trying to get as many people to utilize that product as possible. But some of the other things that we're doing have to do in the appraisal space, where we're trying to make it a lot easier for appraisers to do their job. And we're trying to make sure that the work that they do makes markets equitable. That has become a big talking point, the disparity between different neighborhoods and communities. And we're trying to utilize our knowledge, leverage our technology, leverage our information to help appraisers do a better job in the marketplace. We hope that that's going to have great outcomes, not just for them, but consumers and for the folks who are doing business with us. So be on the lookout for changes that we're implementing. We're going to try to do a few early experiments, if you will, in the marketplace. We'll be talking about those in the next 6 to 8 months as we kind of ramp those up. I would say pay attention to the information that we put out on our single family webpage and see what folks in the market, see what we're thinking about. This is also a great opportunity for you all to let us know if it makes sense, some of the things that we're thinking. Obviously, we're trying to listen to all of the players in the marketplace, especially where it comes to the appraisers, but we need to understand the operational aspects of these things as well. How is it going to impact the work that you do with them? How is it going to impact the way that you underwrite, you take the loan application and so forth? Everything that we're doing, we're trying to do to make it as easy and seamless as possible for you and all the other players in the mortgage manufacturing portion of the business, so that consumers can get the best outcome. So keep looking out for that. One of the other areas that we're focused on, and I mentioned it kind of tangentially, is this idea of equity. One of the things that we've implemented over the last 5 months is we've hired 2 vice presidents, one in single family and one in multifamily, to specifically look at equity, to ensure that everything that we do, products, process, policies, don't have any bias in them that's going to make an outcome inequitable for folks of different race, gender, what have you out in the marketplace. We want to make sure that everybody is getting their fair share of opportunity to get credit from us, so that they can go out and achieve a piece of the American dream. Those are things that we've been ramping up, and you're going to, as I mentioned about the appraisal space, you're going to see a lot of work coming out of both of those shops over the next 6 months. So I would say really pay attention to what we are doing at Freddie Mac, and there are a couple of places you can go to do that. You can go to our single family page. We've just revamped our single family page so that you can find more easily information about some of our products and services that are out there, and we've done the same on the multifamily side. So I would say go to those 2 pages under Freddie Mac and see some of the things that we're doing. But again, let us know what you think. One of the things that I try to tell people all the time is that no matter what we're doing, we recognize that we are not on the front line. We recognize that we're not in your markets, and we also recognize that all markets are different. So in order for us to effectively serve you all, we need to know what it is you guys are seeing, what it is that you guys are hearing from consumers, and what are the obstacles that you're running into. We also need to know what's working, and we need that communication to flow freely. We are not super thin-skinned over here. So if you tell us that something we're doing is absolutely horrible and wrong, we're able to take it. We would also like to hear if we're doing something absolutely beautiful and great. We'd like to hear that too, because that will allow us to know that we can ramp it up and maybe try to replicate it in multiple places. So we need that feedback from you guys on an ongoing basis. And I will say this, the relationship that we have with your organization has been feeding us back, giving us good feedback for a while. And I hope you guys continue to do that, but your feedback doesn't just have to flow through the organization. You as individuals can also share with us your feedback. We look forward to hearing from each and every one of you, as well as your organization. So please feel free to do that. Aside from trying to ensure that we've got a number of different the equitable space moving forward, we're definitely in a position where we're now just trying to figure out how do we continue to grow and exist in a way that is favorable to the market space. There's been I don't want to say a level of turmoil in the marketplace, but we know that there some credit has been tight, so we're looking at that, and we're trying to figure out how can we get past a lot of that and go ahead and continue to provide you guys the services that you need. And that's something that we do on an ongoing basis. We work with our regulator and we work internally. So just so you guys know that any of the policies that we put in place, they're not static. We don't let them sit out there and they just stay out there and we kind of deal with them, once every blue moon. Everything we do is extremely fluid, and we look at it as we look at the market, which is constantly changing. So something that's working well right now, we know may not work well tomorrow. We're constantly looking at it. We're constantly talking to our regulator about the changes they're seeing in the marketplace. And we're constantly talking to our partners in the marketplace about the changes that they're seeing and trying to adjust appropriately. One of the metaphors that I use about us, though, is I try to warn people. I say, we do continually look at the market and continually try to make changes so that we can be positively affecting the marketplace. But we are kind of like the Titanic, big ship, small rudder. So we can see the iceberg, right? And we can make the change. We can hear the people yelling at us. You guys yelling at us, it's iceberg off, the starboard bow, and we can try to move the rudder, but it does take a little while, right? We don't always totally avoid the obstacle. Sometimes we kind of slice it, but we do make the attempt. So I say, just have a little patience with us. We do hear you, and we are trying to incorporate the changes that you guys want into the marketplace. But we're always looking to see what is going on in the marketplace as well. With that, those are really the updates that we've got. There's not a whole lot more right now. Things have kind of slowed down a little bit. We're moving into the summer months. The one thing I will mention, I hope you all have seen it, we did extend the foreclosure moratorium until July 31st. That came out yesterday. And that's just another example of one of these things where we're constantly monitoring the market and changing. The last time we did an extension, everyone assumed that was going to be the last time that we were going to do an extension. We continued to tell people, hey, if things change, we may do it again. And we have. And I will tell you this, if things change and there's required to be another extension, we'll do that again. So just because we've done it, some people may say it's the last one, doesn't mean it's the last one. It really depends on what's going on in the market. And we try to kind of react to what's going on in the market. Outside of that, I don't think I have a whole lot more to share at this point. I'll just open it up. I know probably Roy's got a couple questions. Maybe Audrey has some questions.
There's a queue of questions.
Oh, I'm sure there is. I'm sure there is a queue of questions.
Brokers are the best. They are the front line. They're their boots, on the street. You don't need to ask anybody. Just ask a broker. They'll tell you what's really going on.
Exactly.
Here's a couple. One was, what will the new enhancements for, I forgot the loan prospector's new name, but are there any new enhancements for that coming out?
You know, we're always looking to make enhancements. There's nothing slated. I put it this way, I've not seen anything that says something's coming out tomorrow or next week. But I will tell you this, it's the same comment I just made about the way we look at the market. We're constantly looking at everything we do, and LPA is one of those things. So as changes are required, we're going to be updating it and making new changes. Some of the work that we're doing around appraisals, as those things come to fruition, or we work through the processes and we find that they may work or don't work, we're going to be adding some of that functionality possibly into LPA. So as of this moment, like I said, I don't know of anything that's happening next week, tomorrow, or next week. Or in the next couple of weeks, but we constantly look at our loan prospector. And again, one of the ways to stay in front of that is to really utilize the resources that we have on our single family page, but this one for sellers and servicers, because they always kind of highlight a number of the things that are going to be going on with us. So things that we're thinking about, number one, and then number two, things that we're thinking about ramping out. And when we begin to ask the question, well, what do you guys think about X, Y, and Z? That means we're beginning a thought process where we're trying to implement something. So that'll give you a heads up of a few months about where we're trying to go.
All right. Well, what about, the big news in a lot of parts of the country is some of these home prices are going up really quickly. Are you having any worry in your about are you adjusting your appraisal situation or your automated appraisals with these big jumps and over asking prices or over listing prices, I should say? But
Hey,
does that worry you?
I'm not going to say that. I'm not going to say it doesn't worry us, but I'm not going to say that we're like sitting up there, staring at the wall, going, "What are we going to do? What are we going to do?" We've got some great folks in our economics group. We got some great folks in our modeling group. We're getting excellent information in from the field, very good real-time data. We're hearing from our appraisal partners. We're hearing from our lender partners about things that are going on in the marketplace, and we're trying to stay in front of it. So that we can better handle the risk. And that's really the key. We're trying to explain to the folks who buy the mortgages on the back end from us what that risk looks like, and to keep them settled so that they will continue the flow of money coming into us. If we can let them know that the markets remain stable, then the monies continue to come in, and we'll be able to continue to kind of generate the business that we need to. To this point, folks, they're looking at the markets, they see these run-ups, they know that there's a lack of inventory that's really beginning to constrain this, and we have a great deal of demand. I think what they're seeing a level of optimism about, which hasn't really pushed them over the edge, is that we are beginning to ramp up a little bit in terms of the inventory that's coming online. Some markets better than others, obviously, but people are beginning to see that, and there's some hope there. We've also seen a recent decline in lumber prices. That has helped a little bit. We're hoping that that's going to help keep inflation low and maybe stabilize prices a little bit. We're also hoping that we get a little more folks out in the marketplace to do some of the construction that we need to get done. Again, some markets are beginning to handle that a lot better than others, but because there's that change in the marketplace, I think that has abated some of the real angst over whether or not this is going to be something that's going to cause a meltdown. And I think you hear that not just from organizations like us, but you hear that from organizations like the home builders, the mortgage bankers, some of the bigger lenders, some of the other economists that are out there. So we kind of fall in line with the way those folks are thinking.
Okay. Hey, I got another one for you. It hits me too. This is very important to me because for self-employed borrowers, what are you going to do anything with the COVID, over the overlays where you have to look at the bank statements and check your pulse and go get some kind of health checkup, or I forgot what else you got, or not you, but some of the lenders were putting on. Or is that going to abate a little bit?
Well, one, we're hoping, we're trying to make everybody as comfortable as possible out in the marketplace. So effectively, we're taking a look at everything that we're doing, and we're telling folks, hey, this is the box that you can work in. Now, we can't really control whether or not they do all these other different overlays on top of the things that we do. But what we try to do is say, hey, look, if you operate in the space that we've asked you to operate in, then you're going to have these reps and warrants. You don't have to really worry about all this other stuff. So we're constantly talking with our lender partners saying, hey, look, if we're comfortable in this box, you can be comfortable in that box too. We're going to try to offer you some level of guarantee. So that's really how we try to abate that, get them as comfortable as possible. And, one of the things I tell people, coming out of the Great Recession where you had a bunch of buybacks, people are kind of gun shy, right? So they look at the box and they're like, I want to protect myself a little bit. So I'm going to go a little bit further around that box. And I'm going to do whatever I can do to make myself feel comfortable. The first time that we have to have someone buy something back, but they are definitely outside of the box, and you see that, anything that was in the box didn't have to be bought back, I think that's when people will get comfortable. They'll be like, you know what, they were true to their word, that when it was in this box, they weren't going to buy anything back. And the only reason that they may have is because it's well outside. And that's the problem. So, that's what we try to say. We try to make people as comfortable as possible, understanding that you're a little gun shy, understanding that you're not as trusting as you were in the past. But let us, we're going to continue to talk to you. We're going to continue to show you that you can trust us, that
Okay.
we're going to be true to our word. But again, like I tell people, until the rubber meets the road, where some things happen and those processes have to go into place, I don't think people are going to really understand what that trust means. Not that I'm hoping that happens, right? Because nobody wants an event to happen, but I
Right.
think that's where we are. But we're continuing to talk to our lender partners and try
Well,
to
let me throw another one at you. It's one of those Washington rumor things you pick up over a drink or two. The TPO market. There's some rumors that they may put on some LLPAs on that market. Is that just a big rumor that we're hearing, or?
I put it this way, I've not heard any of that in our shop or not. One, I couldn't. If it's something that was coming out of the regulator, I couldn't talk about it. That's number one.
Okay.
But that's not something, and that would be something if it had come from the regulator. But I will be honest with you, I've not heard any of that.
Right.
So it may just be a big rumor.
Well, that would worry the brokers for sure, because then that just means, there's, in addition, well, I guess we shouldn't talk too much about all that, but I mean, that would have been a regulator piece of it. But let's see, what else? The last question, or go ahead.
No, I was going to say, and that's the other thing that I think people should monitor too. Take a look at FHFA. They are usually really good about putting information out there related to changes that they're going to make. And if they're asking us to make a change, they usually seek some level of feedback or comment. So aside from taking a look at our page to see the things that we're thinking about implementing, take a look at what FHFA is doing. But I would also just kind of ask people to recognize that they are now going through a change at leadership. And because they're going through a change in leadership, maybe some of the rumors that you might have heard prior, they could be, taking a seat back. I don't know that for sure, and I can't say that I know that for sure.
That makes sense.
But just based on, being around Washington, Roy, as long as we've been around Washington, when things change, usually things stop for a moment before they then pick up again. And I would argue that that's probably going to fall. The FHFA will probably fall into.
Yeah, the more I think about it, I think you're right. That's an ebb and flow thing of DC policy. It's like, hey, let's think about it. No, let's don't.
Well, we hurry up and wait. That's what we do. We hurry up and wait.
Hurry up, wait. So if somebody's going to be mad, we can't do that.
That's awesome. Hey, Tony, it's John Hudson here.
Hey, John.
Hey, thanks again for coming out. You know what? One thing that pops in my head, and I love the Credit Smart program.
Yep.
And I don't believe that enough people know what the Credit Smart program is. And I just wanted to see if I could jot you there just to kind of give a little plug for that and how we could be as mortgage brokers, be more engaged in our communities, because quite honestly, as frontline originators, we are the ones that, we're the key to get it to home ownership.
You are.
And putting people into homes. So how can we utilize the Freddie Mac Credit Smart program in our various communities throughout the country?
Yep. John, first of all, thank you. That's a great question, and I feel remiss about not bringing it up, primarily because this month we're celebrating the 20th anniversary of Credit Smart, which is absolutely amazing to me, and we're revamping it. So for the folks who don't know, Credit Smart is a great program. It's about 13 modules, and I think they're going to expand it a bit, that focuses on what it requires to be a homeowner, meaning to get into it, and then what it takes to sustain home ownership. And it's an educational set. So it talks about planning, how you need to save, what you need to do with your credit, it teaches you the terminology, what you need to look for, when you purchase a house in terms of the maintenance schedule and things like that. And it's self-paced. That's number one, it's self-paced, and you can, so that your consumer can take it at their leisure. And the key is, a number of folks whom we work with, a number of lenders whom we work with, if you do a number of modules and get a certificate from us, I think it's 6 or 7 modules that you have to complete. You get a certificate from Freddie Mac saying you've completed a portion of it, or the portion that's required for your home buying education. And then that gives you a bit of a home buying education credit with some of these lenders that are out there. It could save you a little bit of money. It could help you with the qualifications. So it's a good product for consumers to have. Right now, it is in both English and Spanish. I know we're looking to expand that. And like I said, we're actually looking to make it a little bit more broad in terms of its financial literacy education, because we're also trying to get folks who are a lot younger to learn it. So we're building it so that the high schools can use it, maybe 9th through 12th grade. They can start thinking about financing and getting over this bugaboo of what is credit and why is it important, and what is a credit score and why is that important, and how does that play in purchasing a house, and also try to educate them on what are the long-term what's the long-term rationale for owning a house, but what is involved in that. I mean, I know folks, you see that you need to mow the lawn, but what else do you need to do? You got to take care of your roof. You need to take care of weather-wise the house. You've got to make sure that there are no termites possibly. I mean, a lot of folks don't know this. So we're trying to do everything we can to do that. One of the great things that you guys can do, one, you can drive them to our website, credit, and it's Freddie Mac. You can do a search on Credit Smart, and you can have people go through it themselves, but you can also learn to teach Credit Smart. So if you wanted to be an advocate in your market, trying to help people get up to speed, up to snuff on understanding what it takes to get into a house and stay, we can train you to teach to the consumer. So if you wanted to have sessions every week, twice a month, something like that, now you have a tool that you can utilize with back with supporting resources to get that education out there. Great program. A lot of borrower help centers around the country use it. I know a lot of housing counselors use it, but it's not just for them. There are real estate professionals that use it. There are some mortgage brokers that use it. There's some lenders that utilize it, and some LOs that go out there and utilize it. I think it's a great tool, and the new one that's going to be launched in the next week or so, the revised version, is going to be even better. And I would say that if you guys can get a chance to view it, maybe try it out yourselves, push it out to some folks, and then if you're so moved, please, we'd love to have you be folks who are instructors in the community. And we can't get out there and do it, but you guys, like you said, John, I mean, you guys are on the front line, and we need that. We need you guys.
Absolutely, definitely. When the new revamp one pops out, definitely drop Roy a line, and we'll blast it out to our members and say, go utilize this tool. And you nailed on the key points. It's crazy. I mean, we learned how to use checkbooks. Now I've got my kid, my 8-year-old's teaching me how to do Venmo. So their world is a lot different from ours. And so, but yeah, and they don't teach financial literacy like they used to, or they should. And so it's up to us to, breed the new generation of homeowners, because homeownership is the key driver to wealth creation in this country, and not flip this house, but transgenerational wealth creation.
Exactly.
And I've been preaching this from my stump for a while. So I'm glad that it's now a part of the national narrative and conversation, particularly about the disparities in household wealth, primarily driven by home ownership.
That's it, right?
Yep.
That is it.
So
Okay, Tony, I got one last question, and we'll let you get back to what get you back to work. but I guess this has worked out too.
This is work.
So I'm
This is, you know,
always-
this is fun. I'm always trying to talk to people. So all you're
Yeah.
going to do is make me talk to myself when I get off the phone with you guys.
You know, I've been accused of being in Washington where I am so paranoid. You know, Washington makes you paranoid because half the time you don't know if a politician is telling you the truth or not truth, or they're trying to head fake you or whatever. So I'm always paranoid. So my business partner says, "Well, you got to stop being so paranoid because someone's out to kill us. I just know they're out to kill us." So that's what I'm going to ask you. A paranoid Roy wants to know, what is it that brokerage brokers don't know that could kill us? I mean, is there some secret AI project going on in Google's basement, or Amazon's iCloud thingy over there? Are what do we have to worry about, in terms of, oh my God, we're gonna die?
You know what? I'll put it this way. You don't have to worry about anybody getting rid of the mortgage broker function. I mean, you remember back in the day when realtors thought that they were going to get rid of them? They were like, "Oh my
Yes.
God, technology is going to come. Nobody's going to want to purchase."
Yeah.
Well, you got Zillow, you got Trulia, you got Realtor.com, you've got all these different access points to MLS, but you still have to have that personal touch when it comes to sell the house. That's the same way it is with mortgage brokers. I would say the one thing that could cause any individual mortgage broker to find themselves extinct is not staying abreast of technology, not staying abreast of the different products that are out there, not really fully understanding or fully utilizing any of the tools that are coming online. Getting rid of mortgage brokers? Nah, I don't see that happening, because people still need someone in your position who can shop for them to get them the best price on the product that's out there. They can't do it themselves. And when you talk to folks, especially, and I will say this, we have surveyed millennials, we've surveyed this Gen Z, we've surveyed just Gen X homeowners, or people who are thinking about getting into houses. Everybody wants to buy. When we ask them about technology, everybody will use technology. When we ask them, will they buy a home based on technology alone, they sit there and go, no, we'll need a realtor, we'll need a mortgage banker, we'll need a broker, or whoever. They need the experts. And you guys are the experts. You guys are the ones that can help them navigate all the minutia out there about the products and services that are available to them. Most folks, unless you're in the business like us, don't know all that. They're looking for someone they trust. They're looking for someone whom they can sit down with, and who's not, like you said, who's not going to lie to them, not going to push a bunch of BS at them, but going to tell them straight, this is why this product works for you. This is why this product doesn't work for you. I think these would be the best. And they can't get that from a realtor, because then that puts the realtor into the financial space. So they can't, all they can do is recommend that they go talk to an LO or a mortgage broker, and it's up to you guys to sell them on the products and services. And believe me, consumers are going to listen. With everything that's out there, all the information, they don't know where to go. Like I said, they'll hit Zillow, they'll hit, US Bank site, they'll go to their bank's website, whoever, right? JP Morgan Chase, whatever. And my daughter was asking me the other day, in fact, just so you know, I've got her going through Credit Smart. She goes off to college in the fall, and she's got herself a little summer job now. I've got her going through Credit Smart, not just to understand the rationale about buying a house, but really to fully get the money piece. What did she come up to me the other day? She's like, "Dad, I got a note from the school, and they want some payment. And I know you told me that you're going to pay half, and I've got to come up with half. And I still have some outstanding funds, so I'm thinking about a loan. How do I navigate a loan?" And I'm like, you know what? We're going to sit down over the weekend, and we're going to talk. I am her broker when it comes for her trying to understand her portion of how she's going to pay for college. That's the way the regular consumer is. With everything that's out there, they're getting inundated with information. But you guys, the mortgage brokers, you guys are the experts. You see it all, and you know them. You know their situation, right? And you are able to say, hey, I think this is the one that's going to best fit your situation. Because people need that, you guys have nothing to worry about. That's my thought. That's my thought.
Appreciate that. I think I'm in the same boat. I think you can do a lot, but at the end of the day, you just say, I give up. I need someone to give me some advice. So that's
right.
where the mortgage brokers are in. All righty. So thank you very much. I appreciate it. And I will talk to you soon.
Hey, Roy, John,
Hey,
Audrey, hey, thank you guys for having me. As like I said, it's always a pleasure, and I'm always here at your beck and call. Just let
Tony,
me know when you need me.
we appreciate you. Look forward to getting up to DC for live events and having that beer, man.
Hey, there you go. I can't wait to see you guys in person.
All right, take care.
Bye
Right,
now.
take-
I just wanted to say he did a great plug for brokers. I think.
Yes,
I
yeah,
like
no, that's, he's
Uh-huh.
great. So anyway, what we'll do now is we have, let's bring our attorneys on. I see where'd they go or where they go. They'll be coming in here soon. There we go, Richard Horn. So we have the next segment here is one of these issues that, you know, Kimber White has run into this, a feeling of this out there. And so we wanted to sort of do a focus in on and we know from past work with these gentlemen that they're on top of on any kind of new legal arguments that pop up in the mortgage and real estate space. So let me introduce real quick here. Richard, I'll do Richard you first. So Richard is Richard was with the CFPB for many years. He's an attorney on his own right now. You know what? I didn't write Mr. Sturpko. I didn't get your sentence in here, and I apologize. But
That's
I can
good.
say
That's
it.
okay.
I can do it off the top of my head because remember many years ago, I think NAMB was suing people or an agency or two, and NAMB utilized your services. And that's how I know you know this space inside and out. And I appreciate you guys coming on, and Richard, you as well. So anyway, I won't steal your thunder, but it's an interesting discrimination theory, or maybe it has been around for a while, but I'll toss it to you guys here and listen to you what you've run into or what you're worried about that brokers should be worried about.
Yeah, Mark, if you don't mind, I'll kick it off. So probably most of you have heard of the term redlining, and redlining is it's a theory of discrimination under the Equal Credit Opportunity Act and the Fair Housing Act that historically people have said was historically driven by banks drawing a red line around a certain neighborhood, a geographic area, and saying, hey, we're not going to lend to that neighborhood. So if we get applications from there, we'll deny them. We're not going to market to that neighborhood. And so redlining has been since the term was coined, really just about banks not lending to a particular geographic area. Well, now in a lawsuit last year by the CFPB, the term redlining has been expanded, not just to include banks, but also non-bank entities, and also not just geographic areas, but just demographics. It doesn't with a non-bank. Non-banks don't have bank branches. They don't have a Community Reinvestment Act assessment area where they say where they're going to do their marketing and what their market area is. Non-banks typically will take applications from anywhere. They might have a couple offices, but they do a lot of their work over the internet, and so they can take applications from wherever they're licensed, and they don't operate the same way that banks do. So the term redlining really, in a lot of ways, doesn't really apply to non-bank entities. And so for this type of theory against a non-bank entity where the claim by the government is, hey, this non-bank entity isn't marketing enough to a certain demographic, I call it marketing discrimination, and I see that as a subset of what people traditionally term redlining, which, the term redlining, as I mentioned, can really deal with how banks treat actual applicants, people who've walked into the door of a bank, who've called up a bank and have actually applied. The redlining claims can deal with how applicants have higher denial rates or receive higher pricing than certain other demographics. But this marketing discrimination theory is really just dealing with where an entity does its marketing. It doesn't deal with who's getting denied or what their pricing is. And so it's really, it's kind of a subset of redlining. And this is why we wanted to bring it to your attention, because for this theory has been around, marketing discrimination, I'll say, has been around for a while, since the 90s. The first case of marketing discrimination theory was brought against Chevy Chase Bank in DC by DOJ back in, I think, 94, 95. And so it's not a new theory, but the fact that last year the CFPB brought a case against Townstone Financial, which they filed in July of last year, and in full disclosure, Marks and I, along with Sean Burke at Cohen, Manley Burke, Cohen Biederman, another law firm, are representing Townstone in this case. The CFPB sued Townstone with a marketing discrimination theory that's historic because it's the first marketing discrimination case against a non-bank entity, as I mentioned. But this theory has been around for since the 90s, and it's been brought against banks. And the facts that have been brought by DOJ and other regulators against banks have been, as I mentioned, what their Community Reinvestment Act assessment area looks like, where their bank branches are. They've looked at the demographics of a bank's loan officers, where their loan officers' offices are. They've looked at a bank's relationships with other real estate professionals in their MSA, and those facts have been pretty much the same in all of the past bank cases. I'll just name a few of the bank cases. You can look them up yourselves. I know we have limited time, so I'm not going to walk through all of them. But as I mentioned, the first one in the 90s was Chevy Chase, brought by DOJ. There was one as recently as 2018, brought by DOJ against a bank called Klein Bank, where they also looked at the bank's Community Reinvestment Act assessment area. They looked at the location of bank branches. And another important fact in these types of cases, which I should mention, is the HMDA data. The HMDA data is really where agencies kind of build this case out of. They'll look at percentage applications in a particular MSA from the majority minority census tracts of an institution and compare that institution to its peer lenders. So that's another fact that the agencies have looked at in these cases. But when you look at the Townstone case from last year, Townstone Financial was a non-bank mortgage lender. It is based in Chicago, so this case had to deal with the Chicago MSA. And obviously, because it's not a bank, it doesn't have bank branches. It doesn't have a Community Reinvestment Act assessment area, because non-banks obviously aren't subject to CRA. So the CFPB, when they brought this case, had to find other facts to use for this marketing discrimination theory. And they did look at the HMDA data. They alleged that Townstone's HMDA data was statistically significantly lower in terms of percentage applications from majority African-American census tracts in the Chicago MSA versus quote unquote peer lenders. But they had to find other facts to build this case. And the other facts that they used are very interesting, and I think of note for all non-bank entities, because this was really, this theory could be used against other non-banks, and these facts, I think, are things that the CFPB would be interested in with other non-bank entities. So one of the facts is that Townstone, which at all times during the years in question in this lawsuit from 2014 to 2017, the most they had of loan officers, the highest number of loan officers they had at any one point was 6. But the CFPB said because they didn't have one African-American loan officer, they had no African-American loan officers, that was evidence of intentional discrimination, of marketing discrimination. They said that Townstone did not target any marketing to African-American areas or African-Americans in the Chicago MSA. And then they, one thing to note about Townstone was that they had a radio show and a podcast that was weekly. The radio show was on an AM radio station, and the podcast was on the internet. It was weekly from 2014 to 2017. And so that amounts to about hundreds of hours of broadcasting. The CFPB pulled out 5 short statements that probably amounted to about 4 or 5 minutes of airtime and said that those statements would discourage prospective applicants from applying to Townstone or applying for loans in general. And that is really significant because now the CFPB is looking at statements, actual statements by companies. And then these were extemporaneous statements made by the owners and staff of Townstone on a radio show. And I'll tell you a little bit about the radio show. The radio show was an hour program that was meant to educate the public and provide free information to the public about mortgages and the financial markets and real estate. And you can't talk about mortgages for an hour on the radio, or else everyone would basically change the channel or turn off the radio. So they would talk about things that were of interest to listeners. So local politics, national politics, sports, movies, TV. And so these statements were statements that really weren't even about financial issues at all. These were just extemporaneous statements about local politics. A number of the statements were about the high crime rate in the South Side of Chicago and statements in support of the police. There's statements about the lack of adequate grocery stores in the South Side of Chicago. The owner of Townstone actually lived on the South Side of Chicago. He was talking about his own experience, and actually he currently lives with his family in the South Side of Chicago, and his office is located in the South Side of Chicago. So he's talking about where he lives, talking about the lack of adequate grocery stores and what people used to call a particular grocery store on the South Side of Chicago. And those types of statements were called out by the CFPB and saying that they would discourage African-American applicants from applying for credit. So this is this is an expansion of what regulators have traditionally brought in terms of redlining and marketing discrimination cases, because now they're looking at the content of entities' speech. They're looking at the demographics of their loan officer staff and their HMDA data, but the fact that they're not basing these cases on just banking issues. So where bank branches are located, where CRA assessment areas are drawn. This is a huge risk now for all non-bank mortgage companies, both lenders and brokers out there. And I'll hand it off to Mark to talk some about impacts of this on the industry.
Sure. Hey, Roy, great to see you again. And I saw John Hudson on here a few minutes ago as well. So it's a pleasure being around the NAMB crew, which, as you know, years ago, I represented you guys with the loan officer compensation litigation against the Federal Reserve Board, which was still the right thing to do. But anyway.
Marks, thank you for being here, man. We appreciate that.
Anytime. This is as Rich said, this is a pretty important case. Townstone was a lender. It was a small lender in the Chicago marketplace. They're a mortgage brokerage now. They have two loan officers. The CFPB has decided to go all in on this company because they're a small little player, 2-bit player in the industry. And their thought was, hey, we can go ahead and crush these guys and cause a major settlement that will push our agenda, our new discrimination, redlining, equal. There's also an equal advertising doctrine theory that they want to push through. They want to push a bunch of things through that have never been discussed before in the industry. And because Townstone is now a mortgage brokerage, the thought from the Bureau is, hey, we're going to go after not just non-bank lenders, which for the first time, but we're going to use this as kind of a bridge to go after the mortgage brokerage industry as well. So, and that's why it's a really important case, not just for folks who are lenders or banks, but also for the mortgage brokerage industry. So Townstone's a little small company, as Rich said, two folks now. They've been in existence since 2000. They've had a total of about 82 employees. During that period of the 82 employees, 29 were minorities, different sorts of protected classes. But the Bureau said, look, just because you had 29 folks that were in protected classes, you had zero of those folks were African Americans who were loan originators. So it's great that you had out of the 29 that 9 of them, or I think it was 32. 9 of the 32 were African American, but they were not loan originators. So the Bureau says, hey, because they weren't loan originators, that is on its face discriminatory or discrimination, because you're not hiring people for your metropolitan square area that reflect the demographics. So if you're a small operation, it's darn near impossible to meet this sort of criteria. It's almost impossible. I mean, if you're going to start out, you're a 1 or 2 man band. How do you have to meet the demographics of hiring loan officers that meet 60% of the, if you're in a particular area where 60% may be Hispanic or African American or Asian, or it doesn't really matter. If you don't meet that criteria and the numbers don't come in your applications, then it's a problem. The other thing about Townstone has never received it's never had one single complaint from any consumer ever about discrimination. They just haven't had it. Not from the Better Business Bureau, not to the CFPB, not to themselves personally. They've been pretty much as clean as a whistle as you'll find. And because they did not discriminate in this fashion, there were no complaints. The Bureau has decided to elect to look at HMDA data. So when Townstone submitted their HMDA data, the Bureau came back and they started comparing apples to oranges. So they were looking at these super large companies and comparing them to this little small operation in Chicago. And because of that, they were able to skew the data. So when Rich and I were in the case, one of the first things we did is we went and hired the Kleiman Group, which is the same group that the CFPB uses for their consumer testing. The Kleiman Group went into the south side of Chicago, met with a whole bunch of different African Americans that lived in that community, and they listened to the entire audio statements that Townstone had made. Now, let me go back real quick before on the audio statements. There's several hundred hours of audio statements on the Townstone Financial show. There were only I think there was less than 3 minutes of objectionable material that the CFPB found.
Allegedly.
One of the things that the CFPB objected to, but they decided to come off on was Townstone had read actually from the Fannie Mae handbook. And as they were reading from the Fannie Mae handbook on the radio show, the CFPB goes, that's discriminatory. That's discriminatory. Well, it came straight from the Fannie Mae handbook. How can that be discriminatory? So these are the kind of the things that they came up with to try and push these new theories and agendas. Out of the 5, as Rich said, one involved a comment called the Jungle Jewel that they used. They called a grocery store in the south side of Chicago the Jungle Jewel. The Jungle Jewel, unbeknownst to the folks in Washington, D.C. and New York, if you lived in Chicago, it was called the Jungle Jewel because Upton Sinclair wrote a book called The Jungle back in the early 1900s about the hot dog industry in Chicago. And in that neighborhood where they have tours today of the jungle, where people can go do walking tours, bicycle tours, looking at all the old hot dog factories, the grocery store was actually in the jungle. That's why they called it the Jungle Jewel. But the CFPB misinterpreted it to their own detriment, I would say, to make it sound discriminatory. And as the other ones, I said, there was one about the south side of Chicago, about a police comment that they had talked about, and a couple of other little comments. None of them were discriminatory. And so back to the consumer testing that was conducted by the Kleiman Group, they came back, because Rich and I don't know what people would consider discriminatory or not. They came back and they said, look, this was kind of an anomaly. We've never had a study that's come back where every single person said there was nothing offensive or discriminatory or in any way would constitute redlining at all. And in fact, they knew about the Jungle Jewel. They talked about the Jungle Jewel. Everything that Townstone said on the radio show was factual. So then we went and did some HMDA data, and we hired the cross-check compliance, who's out of Chicago. They did a HMDA data review of peers of Townstone, and they came back and said, look, we've looked at the peers, the companies that would be most similarly situated to Townstone, and in looking at that, they were at or above the average for giving loans in the Chicago marketplace. So then the CFPB sort of pivoted as well, and now they're saying, hey, we don't have any applicants at all, and they'll admit this. They have admitted this, that they don't have any applicants at all that have ever complained about being discriminated against. So, but they said, you know, we don't need them we don't need any African Americans to say that they've been discriminated against. They don't know that they've been discriminated against, but we know that they've been discriminated against. So we're going to bring these charges, even though we have no proof. It's our assumptions. So we have the radio show and the loan officer piece. Let's go to this third prong of this new progressive agenda that they're trying to push through. And that is where you advertise. They're trying to create, or they want to create, an equal time advertising rule. That means if I'm advertising in NAMB's newsletter or publication, that's the only place I advertise. If the demographics of that publication do not reflect the demographics of the community in which I'm operating, then I'm discriminating right off the bat. So if I'm, you know, if only 3% of the folks who read NAMB's magazine are African American, right off the bat, you've now discriminated because you haven't reached out to a predominantly African American group. And in this case, they looked at the AM radio station, which their demographics do identify with the MSA of the Chicago marketplace. Same station, it shows the Chicago Bulls, the White Sox, the Blackhawks, as far as the different sporting events. Because they were only on that show and they did not advertise on only African American stations or only on progressive stations, that in the Bureau's eyes constitutes discrimination. So effectively what the Bureau is trying to do is create a platform where it says, hey, look, if you're going to advertise, you need to advertise in proportion to the entire MSA. So if you have Asian transvestites, you need to allocate, you know, and it's 1% of your population, 1% of your marketing needs to be allocated to that. 1% needs to be allocated to this. So they go from not just classes, but subclasses to subclasses. It makes it a very, very dangerous thing for anyone to advertise. And they've even gone further in their thoughts and saying, look, Facebook, if you have an employee and you know that employee, they have their own personal Facebook page, but that personal Facebook page puts the name of your company down, or you get a review from a consumer saying, hey man, thanks for getting me that loan. That personal page is now considered commercial speech and is now relegated by the CFPB. They're now governed by the Bureau. So it's really expansive. Even if that comment, you put the name of your company down 15, 20, 30 years ago, it's now commercial speech, even if nothing else has been mentioned about your company. So the Bureau is trying to really kind of capture that entire your advertising marketing budgets to facilitate on more or less an equal platform across all spheres. And the funny part about Townstone is Townstone actually did allocate a large portion of their budget to advertising on African-American radio stations in the Chicago MSA. The Bureau doesn't mention that in their complaints, but they did. They didn't get any traction. And it's kind of like, you know, if I'm not making any money off this advertising, well, why am I going to continue to advertise here if I'm just throwing money down the hole? So they just went all in on their radio show, which is where they generated all their traffic. So between the having to hire folks, which is this new employment doctrine that they're pushing, the equal time rule or the fair time access rule or theory that they're trying to push through on advertising and marketing, it's a really dangerous case for the industry, because if this goes through, and let's say the Bureau is successful in this case, they force this poor guy into a settlement, it's going to be brutal for the entire industry. I mean, it's going to be, there is no upside, because you're not going to know how to advertise, where to advertise. It's a very, very a dangerous slope that the Bureau has taken on.
So Mark, so should brokers, I don't think, this is not one of those situations where there'll be a regulation or anything like that. This is just a new theory of discrimination that what should brokers be aware of? I know that you've gone through each point, but they should just be cognizant of, how they, is that, I mean, what's the really quick takeaway? Just
the scary part is I think it's going to lock up lending. I think it will lock up lending across the board for mortgage brokers, for banks, for mortgage lenders, because no one is going to know how to advertise unless you're the biggest of the big. Unless you are so large, you can allocate those funds to cover all these different groups in an MSA. Most companies aren't able to do that financially, and I think that's where the Bureau is. It's a good mechanism by the Bureau to consolidate a lot of the players in the industry.
I think a couple big takeaways here are one, watch your speech. Unfortunately, I mean, that's we're litigating this case on behalf of Townstone. We filed a motion to dismiss. We've raised some very interesting administrative law arguments, which would probably make everyone fall asleep if we describe them. But it's really, administrative law arguments like, does the CFPB have authority under the Equal Credit Opportunity Act to have this legal theory? We think not. We argued that in the court. But the other major pieces of this are it's a free speech case. It's a First Amendment case. I mean, the CFPB is trying to use Townstone's language, which apparently the CFPB staff believes is objectionable. But based on our consumer testing, actual residents, African-American residents on the south side of Chicago, didn't have any objection to it. And actually, some of them agreed with it. Some of the participants said, hey, yeah, we like this guy. We would apply to him. Can we get his contact information? Some of them asked for the contact information on the spot. They said, oh, yeah, he knows our neighborhood. And with respect to that Jungle Jewel comment about the grocery store, a couple of them said, oh, yeah, I know that store. Yeah, that's a crazy place, basically echoing the Townstone's owner's comments about the store. And so even if you're just talking about your own neighborhood, things that no one would bat an eye about, no one would disagree with, high rate of crime on the south side of Chicago, that's a fact. You're just saying facts on the radio. People used to call this grocery store Jungle Jewel. That's a fact. But if those facts the CFPB doesn't like, that could result, unfortunately, in CID, with a civil investigative demand from the Bureau, which is expensive to respond to, and in worse, potentially litigation, a lawsuit by the Bureau. So this is going to have a huge chilling effect on speech that CFPB staff doesn't like. And I think, unfortunately, that's going to have an effect on anybody in financial services. So mortgage lenders, mortgage brokers, and keep in mind also, ECOA doesn't just apply to mortgage. So if you know people in auto lending and other types of lending, unsecured lending, this could apply to them as well. So this has far-reaching impacts. It is a really concerning case from a First Amendment perspective, as well as an administrative law perspective. We've also raised a claim, and I think you touched upon this a little, Roy. Like it's not in regulation. There's nothing in a regulation that says you need to have a certain percentage loan officer staff, whether that's African American or Hispanic. They don't even tell you who your peer lenders are, who they're comparing you to. When they do a HMDA analysis, and as you know, the Bureau with all the new HMDA data can really access a lot of data very quickly on where brokers are doing business. The CFPB doesn't tell you who peers are. There's no regulation on that for lenders, let alone brokers. So it's really kind of Kafkaesque. And so we've raised a Fifth Amendment void for vagueness argument, lack of due process, because the CFPB is not telling you how to comply. There's no fair notice of what you have to do to comply with their new theory. And so we're fighting this. We fully briefed a motion to dismiss, and we're just waiting for a decision by the court. But in the meantime, if you want to learn more about the statements in the case, feel free to go to a website that Townstone has set up about this case called townstonefightsforfreespeech.com. That's townstonefightsforfreespeech.com, and you can find out more about the case, about the statements on the radio, and et cetera, et cetera.
Yeah,
All righty, well,
we'll
thank you
get
very
that up.
much. Oh, go ahead, John.
No, I was just gonna say, no, Mark's Ridge, that was great and chilling, and I feel like I'm gonna get my nervous tick back from 8 years ago when it was a previous administration that was, yeah, it was regulation by enforcement and whack-a-mole. So it looks like we're kind of going back in that direction.
We're definitely back there. And this case actually originated from the previous administration. This came from Cordry. They kept it very quiet under the radar. But yeah, this is probably, out of all the CFPB enforcement cases I've ever been involved in, it's the most egregious and most disgusting. I mean, I've never been more disillusioned with the Bureau, and I've been a big proponent of them in this case.
Well, and now it really drives into, I would say that what, if not the primary, one of the primary sources of advertising for all of our membership is social media and Facebook. And, that one little comment that you might have made on a weekend versus, is now part of your commercial umbrella. That is chilling. So, wow. Nuts.
Has a very expansive view of what commercial speech is in this case, which is quite scary, as Mark mentioned.
Okay, well, thank you, gentlemen, for getting that, at least bringing that to our attention. We're going to keep an eye on it, and of course, we'll turn it over now to Kimber White, our president, so he can close out the Ledge conference today. We'll have a members only one here at 4:30. I think that notice went out that we're going to start that a little earlier, talk about some bills we have and other items. So Kimber, let me turn it over to you, and you can say some nice words at the end today. I can't, wait, are you on mute? Uh-oh.
Can you hear me?
Now we can.
You got
yes.
me? Got me. Yeah, thank you, Richard and Mark, for that. As you know, we've talked about that, Roy, about this and what CFPB is going after. So I think this is something we need to watch, we need to follow, because the minorities and these type of things are exactly what the CFPB is going after and has put an emphasis on. With that said, I want to thank you. Wonderful 2 days of a virtual Ledge conference to put it on. Next year, we're going to be live. Look for the dates. It's coming in the spring. We're going to do Ledge and Legislative Conference in DC. Audrey and John, thank you very much, both of you, for hosting this, for doing what you've done with the Legislative Committee this year and what you've done with GA, the work that you've put in. We appreciate that. Each one of you for being here. Thank you. What a very informative day with VA, FHA, Freddie Mac, and now this about the discrimination. I think it was a great informative day. Now, do not forget now when you leave here to go, and registration is open for NAMB National, October 8th through 11th. We are totally sold out. We're all ready. It's going to be a great 3 days. I know we're ready to be in person, to meet, agree, get education, to see each other. So October 8th through 11th, go to NAMB.org. Register for the conference. We're really excited about it. Members, be back in here at 4:30 to hear Roy give update of what's going on in DC, and be prepared. We have some changes, like we said, that's coming for our members only. If you're not a member, join so that maybe you can come back into this at 4:30. And we're really excited about that. Again, thank you all for attending.
And golf, Vegas.
Oh yeah, we have a golf pack tournament on Friday. Jim Neighbors, yes, we have a golf tournament on Friday. So when you're in there, you can sign up for that. It's going to be great. Jim's put a great golf tournament on. Really excited about that. We're really, that's on Friday before the conference for the weekend.
Right, and everybody should come. We're going to there's going to be a little technology corner so everybody can look at and kick the tires on. Well, do I need this software or that software, or what do I hook into what I've got? I like what I have, but I may want to add on to it. So it's going to be a great conference. And thank you all for attending. Send me any I've got very, very thick skin. I live in DC, and just, please ping me with, hey, I like this. I didn't like that. It was too long over here. And you know what? What we may do is spice up the year with sort of like a deep dive on USDA, because I want to take care of those Hawaiians and that lava field some way. And that's what we're going to try to do, is do a quick, that'd be kind of fun, video with the Hawaiians and the lava fields out there. Because, you don't think it's a big problem. It's not a big problem for most of us, but in their world, this is very important. So we need all of us, band together and look at these issues that, some people don't care about flood insurance, Kimber, just FYI. I know
Right.
you're in Florida. Some people live in the mountains. So that's what the National is all about. We gather together and protect each other and have our voices heard. So with that, thanks, Kimber, and thank everyone.
Welcome. Thank you, guys.
You need Lava Zone 2, Roy. We need it now. We lost Lava Zone 2 just now with USDA. I really need your help. That's why I was asking, can VA give their property standards, because they're following FHA property standards. So since VA condo approval is good for USDA, why not their property standards?
I want to be the lobbyist in town that knows everything about Lava Zone 1 and Lava Zone 2, because you never know.
We would appreciate it in Hawaii.
All right.
Gotta do this before I retire, Roy.
All right, we're on it. Take care, everybody. Have a nice weekend, and I hope to see most, or if not all of you, at 4:30. Thank you very much.
Thanks. Bye.